Assalamualaikum and good morning, ladies and gentlemen. We will start this session now. Welcome to the MRA 2020 Workshop for Taxation. My full name is Hasmida Ismail from Competency Framework and Development Department from MRA, and I'll be your host for today. First of all, I would like to thank everyone for attending this workshop. We hope this workshop will benefit all of you as well as students. This is the first 2020 that organized for the taxation topic. We are very happy to have more than 100 academics joining the webinar today. For today, the speaker will be sharing updates on taxation and have a discussion on case study and a few examples of tax question. So to grab this opportunity to ask Mr. Ravi any issue in relation to the topic discussed. For information, the 2020 workshop is part of the initiative of the MRA to enhance the capacity of academicians and to ensure the academicians are updated to the latest changes of the standards, rules and regulations, and to the related accounting, education and profession. This platform, this is the platform whereby the practitioner and industry can share their experience and knowledge to the academician to update the latest changes happening in industry. The information and knowledge will be useful for teaching and learning activities with students. We hope that lecturer will get as much as they can and then to share with students.
So ladies and gents, let's see, yeah. So now, as far as the taxation is concerned, I'm very happy to know that you all are actually interested in taxation. And the one thing I'm not sure whether you'll by the end of this session, you'll be able to completely understand the tax that I'm going to brief you. But one thing that's going to be guaranteed is if you have a good night's sleep later, right, and if you come up in the morning and say I had a fantastic sleep, it may be because you're having this session on tax, right? So that I can guarantee you that you'll have a good night's sleep on after this session, right? So now, as far as tax is concerned, I was actually working in an accounting firm, and then I moved into this local MNC. So I did some exposure. So I've got some experiences that I'd like to share wherever possible, and also now teach. I teach like MI, prepare students for MI, for example, right, and for some other professional bodies like MICPA, and so I'm actually quite. I will do anything for any student who wants to learn, right? So that's my objective of being here and given this opportunity. Okay, but maybe one thing that we noticed from the online session that we're going to have is we're not having it face to face. So maybe being accountants, we are always very creative, right? So maybe we want to give all of us want to give Hasmida and MIA a piece of advice, free advice, right? So normally accountants don't like to give free advice, but this time we want to give Hasmida free advice. So when you have face-to-face, maybe you can give us a voucher during lunch and we can have a lunch using the voucher that I'm not just a joke, okay? So let's start off. Now I've got a few a piece of information on some public holdings, and let's actually start off, okay? Now, there was one that actually relates to what we call this treatment of foreign exchange gains and losses. Okay. Now, this is particularly important because there are certain circumstances where certain cross-border transactions actually gives rise to certain foreign exchange gains or foreign exchange losses, right? So it is very important as far as the Income Tax Act is concerned to make sure that if you're going to claim a deduction, it must be fulfilling the requirements for a deduction, right? So if it is not deductible, then you won't be able to claim it. So that issue is actually very important, especially under the self-assessment system, which has been going on for more than 20 years, right? And because otherwise we could be actually facing penalties for various issues, including incorrect returns. So one of the issues that we normally look into is foreign exchange gains and losses. Right? And there are some basic issues in that gives rise on a cross-border transaction. And but basically, there are certain types of transactions. So let me actually just go into the summary. Now, if there is a gain, let's say that we have a forex gain that actually is meeting certain criteria. Okay. So that if it meets that criteria, then that gain is actually going to be subject to tax, right? So if it is sitting inside your PBT, your profit or loss or your financial income statement, then you do not have to make an adjustment. Okay, so let us see what type of forex gains would be actually taxable, right? So for example, it must meet all these three requirements, right? So based on the public ruling, they have illustrated that it must be trade in nature, right? So trade in nature would be like, for example, if the company is actually buying or purchasing some raw materials or stocks, inventories from your supplier, or if you're supplying some your goods to your customer, or something that is also revenue nature. So that would be trade and revenue, right? So not necessarily that all transactions has to be revenue nature, because we could actually have transactions which is capital nature, right? But the third element is also very important, okay? So it's not only relating to a trade transaction and revenue related. Let's say, for example, now we're actually now selling our goods to a customer, exporting some goods to a customer in, say, Singapore. And the letter say is worth 1 million. And so that actually gives rise to, say, a forex gain of 18,000. It must also be realized, right? So generally speaking, the word realized means it actually means either it's settled or it is paid, right? So the transaction is actually completed. In that case, you do not have to make any adjustments to your amount that is reflected as part of your in arriving in your profits before tax or loss before tax. Okay, but in the event that is not realized, so if there's a gain which is trade in nature, right, which is revenue nature, right, trade and revenue, but it is not realized. Let's say for YA 2021, it has not been realized, then that gain is actually not taxable. Okay, so you do not have to pay tax because it is not meeting the criteria. Okay, so for the year of assessment 2021, you can actually reduce it from your PBT, right? So my 18,000, I can go to my PBT and I can ensure that it is less out. Okay, but it is very important to make sure that you document this information in the tax computation. Okay, so if you're actually involved in preparing it or reviewing the tax computation, say, for example, in practice, that's what we do. So let's say, for example, I'm actually preparing my own tax, my own company's tax computation. Okay, or let's say, for example, I'm working in an accounting firm and I'm preparing the tax computation for my client. Okay, so it is very important to make sure that you reflect that information, that I have a foreign exchange gain of 18,000 that relates to my export of my supply, my sale of goods to my customer in right in Singapore, and this gain is not realized as at YA 2021. Okay, so in the next year, right, in YA 2022, when, for example, we actually receive the amount and we generate this gain, right? So let's say my customer actually settles my amount and there was this forex, this amount that is realized. In that case, you need to go back to the PBT of the current year in YA 2022 and add back that 18,000 which you previously did not tax. Okay, so now this is very important because as we know it, right, as we know it, unlike any audit or any financial report, you know, your FRS's, taxation is actually based on a law, right? Now, being accountants, it is very important to realize that we're actually handling and dealing with the income tax law, right? And of course, we are not lawyers, right? So we are interpreting the law, computing it, right? But at the end of the day, we have to realize that we are actually dealing with the law. Okay. So in the event that something happens, then if there's a dispute, then it might actually land up in various types of various appeals, and it actually lands up in the court, and it's going to be very expensive, right, for the taxpayer or the client, right? Or your our company, for example, the taxpayer company or the client, right? So we want to keep, right? We can't actually say that we cannot be completely 100% risk free, right? It is not possible to say that we are going to prepare a tax return is 100%, right? Guaranteedly correct. We're all human beings, right? But what we can do is we can take certain measures to minimize that risk, right? So therefore, in that case, if I'm actually now going to be, say, for example, I've made a mistake for 18,000, right? So that means if I actually have to pay some taxes on that 18,000, right? In that case, we are trying to minimize it, right? So being able to identify the type of issues such as this cross-border transactions and ensuring that our staff, for example, or our supervisory or management team and our supporting staff actually work together, right, to make sure that we work together to make sure that we get it right as far as is possible. Okay. So likewise, even for our foreign exchange laws, you will notice you need to meet all these three criteria. Okay, you have to be trade, revenue, and realized, right? So therefore, if the loss is actually not realized yet, for example, if it's a trade and revenue related transaction, but it's not realized yet, then of course, that loss will actually not be allowed as a deduction. So therefore, you need to increase your PBT, right? Increase your PBT. Okay, so you have to pay more taxes, right? But again, by increasing a PBT, right? By increasing a PBT, now you see, I don't mind paying taxes, right? But I only want to pay taxes that I have to pay by law, right? So if there is any amount of, say, for example, deduction that I can claim, like for example, in this case, for YA 2021, my Forex loss of say 25,000 was not realized. So I add back 25,000. So I have to pay more taxes as a result of my income, my chargeable income is increased and my tax is increased accordingly, right? But in the following year, when it becomes realized, I can actually claim that as a deduction. Okay, so that would actually neutralize, right? So in the previous year, I actually paid more taxes, but in the following year, I would be able to claim a deduction because I'm meeting all the requirement. It is trade related, it is revenue, right? And it's realized. Okay, but likewise, if there is a non-taxable gain, for example, right, that relates to a non-trade or a capital transaction, and if it is, whether it is realized or unrealized, it does not matter, right? So that, let's say, for example, if there's a settlement of a loan, right, for which you are not entitled, it's not revenue in nature, it's capital nature, right? Or if it's a non-trade transaction, in that case, then you will not be, you need not be required to actually pay taxes in that. So that Forex gain would actually be not subject to taxes, right? So like using simple, right, using a simple method, right? So the IRB is actually very interested, right, if you add back and increase items to your income, right? So if you add certain things to your income, the IRB likes it, right? But the minute you go, let's say, for example, you had a 33,000 worth of a non-trade Forex gain. So let's say, for example, in your income statement, you had a 33,000 Forex gain, and from your PBT, you reduced it. So you reduced your income. So in arriving in your income, your adjusted income, you have reduced, right? So whenever there is anything that is going to reduce any income, it's very important to make sure that it better be correct, right? Because you have actually now reduced in income, right? Now, I mean, we're not doing things for IRB's sake. We're actually doing it because of the law, right? The law requires that if it is non-taxable, then you don't have to pay tax on it, right? But you got to have sufficient evidence and proof and documentary evidence. So you've got to make sure that the transaction is capable of being produced. So, and another piece of advice that I would like to actually share with you is this: when you are now preparing a tax computation for YA 2021, okay, let's say, for example, you're preparing it in June in 2022, but you're preparing a tax computation for YA 2021. It is very important that you make sure that you capture the information in your tax records or your tax computation at the earliest point. Okay, so say, for example, now you're going to now reduce, right? So your forex gain is a non-trade gain, so therefore forex gain is not subject to tax. So you reduce 33,000, right, from your PBT, but you do not provide information on that deduction to the notes of to your tax computation, right? And in the event of an audit, say, let's say, for example, in YA 2021, there was an audit into YA 2024. And when you are now in 2024, when the IRB officers during a tax audit is asking, can you please tell me, right? Can you give me some proof on what is the nature of this transaction? Can you give me some information, right? If you have not captured that information in your tax computation, which you prepared for YA 2021 in 2022, then you may be causing a delay, right? Now, the last thing we want to do is delay, right? As you know, delay defeats equity, right? So if you had actually captured the information at the earliest point, then you might have avoided this, right? So that is another thing that is very important, right? So we must realize that there's always this control feature in our self-assessment system, right? And making sure that if the tax, if your staff, for example, right? So let's say you're the manager there and your employee is actually preparing the tax computation, right? If you make this information that you've got to make sure that you prepare the information and attach the documentary proof to the tax computation when you're preparing it, right? If that employee or that staff actually is aware of it, they will do it, right? So that's some kind of very proper guidance is actually very useful. So the proper guidance, right? So these are some of the sort of, nowadays we actually talk about, I think recently, yesterday, I think it was MIA actually had this conference and they were looking at governance issues, right? And the panelists were actually talking about governance. Yeah, some of you might have actually attended that MIA conference, but these are some of the things that the IRB actually likes from a taxpayer, right? Get your information, right? Make it simple, right? Don't make it too complicating, right? Don't delay things, right? I ask you for information, you don't delay it, okay? And likewise for certain foreign exchange losses, if it is actually arising from a non-trade or a capital transaction, whether it's realized or not, it does not matter. It is not deductible, okay? So let us actually look at some type of transactions where it is either revenue or right. So sometimes we actually have let me just get let me get my highlighter. Okay. So on imports, right? So on imports, right? And then if you have any foreign operations, right? So maybe you're having some operations and you may be having transactions, right, where you acquire or dispose of assets denominated in a foreign currency, right? And borrowing is actually very common, right? Very common borrowing and lending of money. So that actually gives rise to what we call foreign exchange differences. So if it is actually relating to what we call this normal income earning operations, right? Now, the slides that I actually have is a little bit verbose, right? And I don't want to actually go through each item, but I just want to select one item and explain it to you so it's much easier, because generally speaking, it's actually helpful. But actually, it's not a good idea to have too many words in a slide. But I just want to highlight to you that that this information is generally all the information is actually quite useful. Okay, so normal income earning operations is considered to be it normally occurs. Like, for example, if you're purchasing trading stocks, okay. But if it is a conversion of foreign currency, which is part of the trading asset of a business, and it's incurred in the course of carrying on a business, then it depends on whether it is revenue or not. Okay, it actually depends. Okay. Okay, so let's look at yeah. So let's say, for example, a company is actually now say buying silk garments, right? And so right. So this. Okay, so let's look at this example, right? This case study is actually given to us in the public ruling. Sorry, let me just get to my, yeah, sorry. Okay, so let's say KK is actually now specializes in producing silk garments, right? So they're actually buying it from a Korean supplier. So what in this particular case is the Malaysian company actually accumulates a large amount of this currency, right? This won, the South Korean currency won, to finance the purchase of this this material, right? But it is actually not involved in foreign currency speculation, right? So the Malaysian company is not involved in foreign currency speculation. And due to certain circumstances, the company actually ceased all purchases from the supplier. Okay, so that supply is no longer existing. So therefore, we had this huge amount of foreign currency, right? And so they sell it to a licensed money changer, right? So this conversion of the South Korean won actually ends up in a forex loss. Okay, so this South Korean won is actually was part of a circulating capital used, right, in the ordinary course of your business. But the forex loss upon conversion of the foreign currency to RM is a trade loss, okay, and it was not accumulated as a temporary investment. So the forex loss upon conversion is not considered to be a capital, right? So it is very important, like I said, to make sure that you have this information and documentary records to support, right, the view that it is revenue, right, and deductible. Okay, so therefore the process is actually very helpful as far as the IRB during a tax audit is concerned. Okay. Now, capital transactions involve, say, assets of enduring value. Say, for example, if it is, say, you're actually investing in a company, you know, let's say you set up a subsidiary in Vietnam, right, and you're investing in your subsidiaries. So if you make such transactions, that would be actually considered to be a one-off payment, right, and that brings into existence an asset or advantage, right, for enduring benefit, right. So that would be one of the guidance given to us on what type of transaction is considered to be capital, right? So if it is initial in nature, if it's a one lump sum payment, or if it's a expenditure that is bringing into existence an asset or advantage for an enduring benefit, or it's affecting the structure of the company, it's all considered to be capital, right? So if the purpose is to establish or replace or enlarge the capital, it is considered to be capital, right? So there's a very simple example given to us. So Sindham Bahad, an importer of Italian marble deposits in Italian liras, right, in an Italian bank before remitting an advance payment, right, to the Italian exporter, right. Before the advance payment was made, the ringgit actually appreciated against the lira, and actually realized an exchange gain by disposing its Italian lira to the Italian bank. Okay, so now they're actually not now making a settlement, right? They wanted to make some money because the ringgit had appreciated, right? So in this case, the forex exchange gain is actually not taxable, and it is not arising from a revenue or trade transaction. It is purely speculative in nature, and it arose, right? It was an appreciation of a investment. Okay, so in this case, if it is a foreign exchange gain, even though it is actually related to purchases, right? In this particular case, if it is speculative in nature and if it relates to an investment, then it is not taxable. Okay. And like I said, if the law permits you and allows you to say that a gain is actually not subject to tax, it is very important to make sure that you do not pay tax on it. Right. So there are circumstances where it is taxable. Like, for example, if it's a foreign exchange loss, then of course you won't be able to get a reduction, right? So if it's a forex loss, right, then it's not deductible because it relates to your investment, right? It relates to speculative, right? And the main reason there was this is one of the main reasons I actually wanted to come to this public ruling, right? This because this one reason. Okay, so let's say, for example, now I've got a company that is actually buying a machine, right, from Japan. Okay, so this forex loss. Okay, so I've got a forex loss was sitting in my income statement. Okay, this forex loss was sitting in my income statement. Okay, so let's say it's 100,000. Let's say it's 100,000, right? So I'm buying a machine. Let's say it is worth say equivalent to say 2 million, right? So it's worth 66 million yen. So it's worth about 2 million Malaysian ringgits. So I'm buying this machine from Japan, and I'm actually incurring a forex loss. Okay, and let's say, for example, I've already made my settlement. I've settled the amount of the 66 million yen, right? And let's say it is realized. Okay, so for tax purposes now, we need to we need to analyze to see whether it is a deductible loss or not, right? Whether the loss is deductible or not. So in this case, if it is a trade, right? Is it revenue is realized? Unfortunately, it is not revenue in nature. It is capital in nature. Therefore, it is not going to be deductible. Okay. So you need to add back. Now, the minute you add back, right, in arriving at your adjusted income, you're going to pay more taxes. Okay. Now, that seems to be unfair, right? Because I'm actually buying it for my business purposes, right? I'm actually carrying out a manufacturing, I'm a manufacturing company, and I am buying it for my business. But because it is capital nature, I will not be able to get a deduction for it, right? So now, this is the point that I notice from an accounting perspective. The information is given to us in your audit report, right? In your audit statements, right? But so the forex loss is actually stated in your disclosure items, right? So I know the 100,000 is sitting in the disclosure items, so I know what to do with it. Okay, so I have made the correct adjustment, right? But what a lot of tax computations actually fail to do is, right? Now you can actually go to the cost of the machine. Okay, you can add any freight charges, right? That would have been capitalized in your. Let's assume that it's capitalized in your balance sheet, right? Yeah, right. But in this case, so this forex loss. Sorry, there's a typo here. Let me just change this. Sorry, huh? The forex loss. Forex loss can be claimed as a deduction, right? So now what you notice here, it neutralizes the transaction. It neutralizes the transaction. That means you have increased your income, but that benefit lost right? You're actually losing a benefit because you have to pay more taxes, is actually matched or neutralized by increasing the cost of the machine. Okay, so the qualifying plant expenditure or qualifying capital expenditure, right, for capital allowances purposes is going to be based on the amount that includes the forex loss. Okay, so what we notice is, especially when we're doing, say, audit current year tax provisions, we notice that this point is normally not picked up. This point is not normally picked up. Okay. Now, in this case, of course, the RB will be extremely happy, right? If you don't pick up the 100,000, right? So they'll tell me, Ravi, terima kasih banyak, right? Because you only claimed 2,080,000, right? So what happened is, because I did not claim it, because I didn't add this back, so I would actually disallow this amount, and I would claim based on a lower amount, right? So the IRB will be extremely happy with me, right? But actually, I'm entitled to claim my capital allowances on a higher amount. Okay. Now let us take it the other way around. Okay, let's take it another way around. Okay, so this is no longer a forex loss. I'll just change it to forex gain. Okay, so in this case, it includes a gain of 100,000, right? So in this case, I would less, right? I would less my, right? I could less my forex gain. I would less, right? So it'll be 2.4. And in this case, I need to less, right? I need to less, need to less, right? So my forex gain, right? So this will be 2.4, right? And this will be of course a lower amount. Okay, it'll be a lower amount. Okay. Now, if you don't do this, right? So let's say, for example, now, right? If it is 2080, let me just get out my calculator. Right, so it is 2 million minus 100,000. Then I'm already, my qualifying capex is 1980. So it'll be 1, 1, 9, 980. Okay, it'll be 1980. And in that case, right, in that case, I have actually overclaimed my cap allowances, right? Because if I have not actually made this adjustment, I would have claimed cap allowances based on a higher amount. I would have claimed CAs on 2,080,000, right? So that would mean that you have submitted an incorrect return. Now that is a very serious offense. Okay, I have got one slide, right? I think one of my last slides is actually on what we call this anti-money laundering. Right, there's a very famous act, right, that I have got a slide. So towards the end of the session of this talk on this, I want to show you the slide, right, on the consequences of an incorrect return. Right, we must avoid it as far as possible. Okay, as far as possible. Okay, as far as possible. Okay, so yeah, so that is on the forex gain of forex loss. Okay, forex gain, right? So normally when I'm doing these examples, I tend to change my slides, and sometimes I forget to put it back. Okay, so let me just put it back first, so that I won't have to worry about. So all this will be coming back. So that is the main reason actually I chose this this relatively new public ruling. Now here there was another issue that was also quite interesting in the public ruling that I just want to highlight, right? So more or less we have an idea now, and more or less we have an idea. Okay. Yeah. Yeah. So yeah. Yes. So there was a question asked on the yeah. So on the forex gains, there is certain information that we need to go through, and now I don't actually have access to your chats while I'm actually giving the talk, right? But because Teams actually doesn't allow us to have a chat while we're having it, while our slide is actually being shown. Okay, so I'll look at the chats later, but let me finish it off. Okay, now as far as borrowings is concerned, let me just get my highlighter. Okay, the borrowings is concerned. Okay, so you have various purposes, right? So the purpose of borrowings, right? So it actually depends on what purpose. And right, so if it's a business entity's purpose is entering into a loan agreement, and the nature of the person's trade is fundamental, right? So whether forex gain or loss, repayment of the loan is revenue or not, would depend on the what we call this underlying transaction, the nature of the underlying transaction. Okay, so is it revenue or capital? Right. So if the foreign currency borrowings are used in the ordinary course of business, right, in the ordinary course of business, okay, such as your, say, paying your rental expenses or purchasing your trading stocks, for example, any forex gain or loss would be considered to be revenue, and you can claim it when it is realized. Okay, so we need to examine the underlying nature of the transaction. Okay, so for tax purposes, you need to demonstrate to the IRB what is that underlying transaction is concerned. Okay, not really what the transaction is, what is the underlying reason. Okay, now similarly, if the foreign currency borrowings are taken by a finance company, okay, and in the course of they're providing funds for on lending to customers, right? So that that would of course be clearly that forex gain or loss would be considered to be revenue, because it's actually in the ordinary course of business, right? It was they actually lend money. So if the customer doesn't pay, clearly it is a taxable gain and a deductible loss, right? So the forex exchange gain and the forex exchange loss will be considered to be revenue in nature, right? Now, if the foreign currency borrowings are used to purchase capital assets, so any forex gain or loss on repayment of the borrowings would be considered to be capital nature. Okay, so that would what we saw earlier is capital nature. Okay, now where the foreign currency borrowings are taken to remedy the to remedy the say undercapitalization, right? Undercapitalization. Okay, so there's this word called undercapitalization, right? The forex gain or loss on repayment is not automatically considered capital nature. Okay, so in most cases, the nature of the forex gain or loss is determined by the use of the use made of the money, right? So the purpose of the borrowings would be still need to be determined, right? Now, if the money borrowed may form part of an entity's own funds, right? So there's one word called entity's own funds. Okay, so now you need to support your information by saying that if it is forming part of the entity's own funds, right? So in such a case, the borrowed money would generally be considered to be form part of your permanent working capital. I'll just call this as PWC. I just called it as PWC. It's not PW, I mean, right? I'm just calling it PWC, right? So if it is relating to PWC of your business, right? Your permanent working capital. So note the word permanent. Okay. That is considered to be capital. Okay. So if you borrow money and if it's forming part of my PWC, that means it's actually permanent working capital, permanent, right? Then that would be capital nature. Okay. So any resulting forex gain or loss would be considered to be capital, right? And here you need to be very careful, because regardless of how the money borrowed is eventually used, right? As such, determining whether borrowed funds in fact forms part of the owns funds, right, would depend on the specific circumstances and facts of each situation. Okay. 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 So now there's a guide. No, so no, the probabilities of actually you getting it right is very high because of the guides given to us, right? So we thank, right? So this government is actually doing a very good job of actually explaining the taxpayers on the various issues so that we get it right as far as possible, right? So this is what exactly we want, right? As taxpayers, this is exactly what we want. So let's examine this. Okay, let's examine this, right? Just a little bit of just spend a little bit of time here because it has got some issues that may help. Okay, so my PWC, my permanent working capital, means the it's the minimum level of all current assets to be maintained at all times by an entity to ensure a minimum level of uninterrupted business. Okay, so this amount varies from year to year. Okay. Now your working capital means your capital funds required for your day-to-day operations. So here it becomes a little bit more specifically relating to day-to-day ops of the business. So working capital, which is over and above the PWC, is the excess of current assets over your current liabilities. Okay, so there are some nice, very good examples given to us as a guide. Okay, so let's say, for example, D, a Malaysian company, D borrowed 1 billion Japanese yen from a Japanese bank to buy a factory, right, in Malaysia, right? So the repayment schedule is about 10 years, right? And due to the appreciation of the Japanese yen, D incurred a forex loss, right, every year on repayment of the borrowings. Okay, so the foreign currency borrowing cost was utilized to purchase a capital asset. Okay, so for the forex loss that arose from the repayment of the borrowings used to purchase the capital asset is capital in nature. Okay, so that is actually a little bit straightforward. Okay. So now let me actually just try to see if there's any issues that you have for this so that I can clear this off. Yeah, I mean, you can actually, for the formats, you can actually have a look at it, right? On the treatment of, so there's a question here. Yeah, so can you show us a format on the treatment of both realized and unrealized Forex as part of the discussion? There's a format, there's a summary given to you, so that would be useful, right? So that is also there. And then the Forex differences arose from the loan or interest payments, right? So it's not necessarily that if the underlying transactions are relating to a working capital, for example, if it's relating to day-to-day operations, then you can actually claim it. Okay. Yeah, and so there are various examples given to you. Okay, and yeah, so that actually, so it's not necessarily when you're actually repaying the amount, the interest can be deductible or not, depending on the underlying transaction. Okay, so now we shall move on to the next one, right? So this one is also an area which is actually quite controversial. Okay, and I think I've got one tax case that I want to discuss in the afternoon relating to withholding taxes. Okay, there's one case law, right? But generally speaking, if you look at this nice summary, withholding tax is actually a very significant. It's very significant because Malaysia actually relies a lot of cross-border transactions. Okay. So if you look at certain transactions such as dealing with a non-resident relating to royalties. So let's say, for example, now I'm actually now manufacturing a product and I have under a licensing agreement with the Japanese, say that my holding company is in Japan, and the Malaysian company is actually entering into a licensing agreement to manufacture the products. Then depending on certain facts and circumstances, such as is a royalty within the scope of income tax, right? So if you look at Section 3 actually says that any income, right, which is income in nature, not capital nature, which is income in nature, will be taxed for each YA. It'll be subject to an income tax, right? It's called income tax, and that income, right? But that income is not defined, right? So, but that definition is not given to us in our act, but they've given us a classification of royalty, right? So this royalty income is actually included in Section 4 small d. Okay, so therefore it is within the scope or charging section, right? So the income of the non-resident, right? So let's say, for example, we call it as, say, Sony Japan, right? So Sony Manufacturing Malaysia is making payments of royalties to Sony Japan. Okay, so is that income within the scope of or within the charging section of the Income Tax Act? The answer is yes. Okay, it is caught within Section 3 and Section 4 small d. Okay, but that does not determine whether it is subject to withholding tax or yes or no. Okay, we still need to determine whether that income is derived or deemed derived. Okay, so if you go to Section 15, so if I just go to Section 15, okay, let me just get hold of this the Act. All right, so let me just get hold of this. So I just want to, it's not necessarily a point, but I just want to highlight something about this issue that is very, very important, right? So if we go to section, say 15, section 15. So, right, so this derivative, I'm not going to actually be sitting here and actually discussing on tax, right, and giving you advice. I'm not here for that. I'm just going to give a brief view on what is it. But I just wanted to highlight only one point, right? Now, whenever you see this 4-letter word called deem, you need to pay particular attention. That's all I come here. The reason why I'm coming to this is I'm not here to explain what section 15 is. I will leave that with you. But all I'm just telling you is whenever you see any word in any act, in any Malaysian act, right, whether it's RPGT or it's income tax, this word, this very simple 4-letter word is very, very powerful. Okay. So let us just sit and let's examine what this word deem actually means. Okay, let's say, for example, today is Wednesday, right? But according to the act, it's deemed to be Saturday. No, but it's not Saturday. It is Wednesday, right? So it is something that is not. Effectively, right? So the act says no, it is Saturday. No, but it's not. It's today's Friday. I mean, today's Wednesday, right? So in this case, it is something that is not, right? So it's actually got very powerful connotations. Okay, now, so coming back here, right? So coming back here. So here under the derivation rules, right? So if you look at, okay, sorry, yeah, let me just, since it's already open here. So if you look at section 15, for example, if it says that if the royalty is actually is made, if the royalty is paid, right? It's deemed to be derived if the responsibility lies with the person who is resident, right? So if you look at the definition of the derivation rules or the deemed derivation rules, if a person who is making the payment is a resident, then it is deemed the income of the Japanese non-resident or the royalty, right? So the royalty income received by the Japanese non-resident will be deemed to be derived from Malaysia because you're fulfilling one of the criteria. Okay. Okay. Once you fulfill this derivation rule, then only you're going to be subject to withholding taxes. If the income is not derived from Malaysia, then it is not going to be subject to withholding taxes. Okay, so you need to fulfill generally the important criteria before withholding taxes are applicable, right? In certain cases, of course, the amount that you pay may be reduced under certain treaties, right? So Malaysia has actually got a huge number of treaties, right? So if I look at the IRB website here, right? So if I go to say international, if I go to DTAs, right? If I go to DTAs, if I go to double taxation agreements. So there are certain treaties. So if I go to the summary of the DTA rates, right, in the IRB websites. So if you look at certain, like for example, the withholding tax is 10% for royalties, right? But there are certain treaties where the rate is lower. So the maximum is 10%, but in certain treaties, for example, Germany, you've got like for example, if you got Netherlands, for example, is the same. But if you go to Hong Kong is 8. Okay. If you go to Singapore, right? Singapore is 8. So let's say, for example, now you're actually entering into a transaction with a US company. Okay. And let's say, for example, now you're making you're entering into a licensing agreement with a US company. Now, the US does not have a treaty. We don't have a treaty. We don't have a full-fledged treaty with the US. Okay. We have a we don't have a full-fledged treaty, right? We have a limited shipping, right? So generally speaking, for Argentina, US, we don't have a full-fledged treaty. So let's say, for example, now the Malaysian company is actually entering into an agreement, licensing agreement with the US company, right? So then in that case, when we're making the payments of royalties, we are now fulfilling all the criteria, right? And let's assume that the company who's making the payment is either a resident or it is actually charged into the Malaysian derived income. Then in that case, it is deemed to be derived. So therefore, it's subject to withholding taxes. Okay. So in this case, of course, the withholding tax now of, say, let's say, for example, I'm paying 100,000 royalty to the US company. I have to deduct 10%. So therefore, I'll be paying 90,000 to the US company, the net amount, and the 10,000 I have to remit to the IRB, right, to the Malaysian IRB within the due date, right? So normally it is actually within 1 month of crediting or paying the non-resident, okay? But instead of actually structuring it in such a manner, we can actually look at it in such a way whereby I don't have the license agreement with the US company. I actually have it with a company in Hong Kong. Okay, so the US company now assigns the rights to the Hong Kong company. Okay, and when the Malaysian, let's assume that the company is actually resident in Hong Kong, right? So the Hong Kong company, and when the Malaysian company actually enters into agreement with the with the Hong Kong company, we could be actually able to enjoy the lower rate. But there are some criteria and conditions to meet. And if I can meet those conditions, then I'm from a group perspective, we could be paying lesser withholding taxes. Okay. Now, you might have actually heard of this very, very famous in most budgets, they actually discuss it, most tax conferences, they discuss it on what we call this BEPS, right? This base erosion profit shifting, right? So they want to actually go and attack transactions where you're going to abuse, right? That means you know, this treaty, right? You're abusing the treaty benefits, okay? So you must make sure that there is substance in the transactions that you are undertaking, right? So if you want to enjoy the lower rate, you got to make sure that there's substance, right, in Hong Kong, right? It's not a shell company, right? And you're only purely entering into an agreement to avoid or reduce paying withholding taxes, right? In that case now, most governments have actually now agreed to work together on this, right? To see whether it is genuine or not genuine. If it's a genuine transaction, then all the governments are quite happy, right? So you've actually now reduced the withholding tax. It was 10,000 earlier. Now you're actually going to be only paying, let's say, for example, right? If it is 8%, it's only 8,000 out of 100,000, right? Now, is that a genuine transaction? So the IRB will be very interested to check it. Okay, so there's a lot of information that's going to be requested, right? To make sure, right, that is meeting all the relevant, because that is actually something not exactly within our control, but that is something that is impacting the revenue base for the Malaysian government. Okay, but such transactions do take place. Okay, so if you take one line item, let me just get my highlighter here. So if I take my royalty, I got to check what is the charging section. Is it derived or deemed derived from Malaysia? Then there is a withholding tax section under 109, and that is the normal rate given to us, right? Is 10% for royalties. and it is a final tax. So the non-resident is not required to submit any further tax returns. So it becomes a final tax. Okay. So likewise, for example, interest, right? If you're borrowing money from an overseas, your say parent company in Japan, and if it is interest income is covered under Section 4 small c, and it's derived or deemed derived if the money that you use, right, that you borrow money and you're using it for Malaysian business, then it's deemed derived, right? And assuming that you're a resident person and you are subjected to withholding tax under 109, and the rate is actually 15%, right? So in this case, again, I might want to go and see if I'm borrowing from, say, from like the US, for example, let me go and see whether if I go and borrow from, say, a Hong Kong company, then the withholding tax is reduced to 10%. Okay. If I go to Japan, for example, right? If I pay interest, the rate of withholding tax is 10%. Okay. So if I'm actually going to borrow from a jurisdiction where I don't have a treaty, like, for example, the US or Argentina, then I will not be actually entering into the transaction. I will actually try to borrow the money from a Japanese, and therefore the withholding tax can be reduced, right? There are some withholding taxes actually much, like, for example, if you go to Middle East, you're borrowing it from somebody from, say, Qatar, or even I think Saudi Arabia is, yeah, so these 5%. It's also quite low. Okay, and UAE is also fine, right? So it's also quite, so we've got some very good treaties for interest, but it must be a genuine transaction, like I said, okay? Because if it's not a genuine transaction, you're in big trouble, right? I've already explained to you what trouble, but it is big trouble for us if we submit an incorrect return, okay? Likewise, we have this very controversial, right? Let me get my highlighter. Right, so we got this what we call the special class of income, right? It's primarily made up of technical fees and non-technical fees, right? So it includes non-technical fees, it includes installation fees, it includes management fees, design fees, right? But arising from a major change in 2017, right? It is only deemed to be derived, right? Again, if you see the word, if you look at the act, there's this deemed provisions over there. So it's a deeming provision, right? So in this case, for services performed in Malaysia, right? And for offshore, it is exempt, right? So it means onshore, you have to pay taxes. So if the services are performed onshore, it is subject to tax, but for offshore, it is exempted, right? So again, you need to be particularly having the relevant documentation. Like, so for example, you have a contract with a Japanese non-resident. Okay, let's say, for example, you're having a contract with a Japanese non-resident for a 10-day job, but out of which 5 days will be actually performed in Malaysia and 5 days will be performed in Japan. And let's say the total fees is 100,000. In that case, you'll actually have to subject to withholding tax only on the days that you perform the services in Malaysia, which is relating to the 5 days. So 5 divided by 10 days. So the 50,000 will be subject to a withholding tax, right? And the rate of withholding tax for Japan is 10%. Okay. Now, again, this word non-technical, right? It was also recently introduced after a lot of major changes and a lot of cases that landed up in the court, right? So according to the RB, even non-technical related services are also within the scope, right? So here we need to be quite careful. We need to be careful because any type of services is now within the scope of Section 4 capital A, right? So it's Section 4A, right? So the derivation rules are actually given to you under Section 15, but there is this exemption order given to us in 2017. I think I've got it written down in somewhere in the slides, which I'll show you. So if it is performed outside of Malaysia, then for services that is covered under Section 4 capital A is not within the scope of tax, because we have an exemption order that says for any installation services or any type of services that is rendered outside of Malaysia, then it is exempt. Okay. But assuming that it is actually now performed inside Malaysia, then there's a very famous Section 109 capital B, right, where the rate is actually a maximum of 10%, right, and the final tax is the final tax. So the non-resident does not have to submit any more tax returns, right? But there is one item that is included in Section 4A, which is not necessarily relating to services. It doesn't relate to services, right? It actually relates to something called a rental of movable property, right? So anything that moves, like a plane, a train, right? Anything, an equipment, right? And any a property that or an asset that doesn't move, we hope too much, right? So even though, so one thing that doesn't move, right, is a building. Right, so a building is not supposed to move. So even if it moves, also hopefully it's not going to move too much. Okay, so that right, so that would be considered to be an immovable property. But otherwise, right, rental of any movable properties is also within the scope of Section 4 capital A, and therefore we got to check and see whether it's deemed derived from Malaysia, and then that is a withholding tax on 109B, right, and the rate is 10%. Okay, now. There's one type of payment that is actually now considered to be a long-term. What we generally consider as carrying out a business in Malaysia, or what we call a place of business in Malaysia, or we have under the DTA called permanent establishment. Right. So typically, if you're actually carrying out an activity, like for example, if you're carrying out a construction activity or a building or a construction or an installation or an assembly or a supervisory activity, which is more than 6 months, then generally speaking, you're considered to have a permanent establishment or a what we call a place of business. Okay, this place of business. Okay, so this POB rules, right, and the permanent establishment rules, okay, normally relates to such payments. Like, for example, now the Twin Towers, right? So the Twin Towers is actually constructed by 2 non-residents, right? So it is actually constructed by a non-resident Korean and a Japanese, right? So Korean 2 non-residents actually. So when we made the payments to them, let's say we actually made, say 2 billion worth to ringgits to each non-resident, the 2 billion is not subject to withholding taxes, right? Only the service portion is subject to withholding taxes. Okay, so to construct one tower, let's say it's 2 billion. Let's say 1.8 billion relates to the equipment, the materials, right? You know, the beautiful steel structure, right? So all that is not subject to withholding taxes, right? Under 107A, right? There is no withholding tax on equipment, materials, right? But for the 200, the balance of the 200 million would be regarded as your service portion. And if it is caught under 107A, then there will be a 10% on the service portion and another 3% on the service portion, right? So we don't call it 10 plus 3 is 13. We call it as 10 plus 3. And this 10 plus 3, the 10% is on account of the non-residents income tax liability, right? So the non-resident companies, let's say, for example, Hazama Gumi Limited, they constructed one of the towers, right? So they would actually have to submit tax returns because it's not a final tax. Okay, so the non-resident has to declare their income, submit tax returns, right? And once you determine your tax liability, you can claim a tax credit for this 10%. So basically, it's an advance tax that we are making a deduction, right? But the responsibility is actually given to the person who's making the payment. So the Malaysian company, for example, let's say it's KLCC Holdings, Sinar Bahar is making the payments. The responsibility falls on the person who's making the payment. Okay, so this is to make sure that the non-resident does not run away without paying taxes. Okay, as you know, we were actually, in fact, I would actually say certain transactions actually still are being carried out by non-residents, right? So there's another 3% that relates to the employees of the non-resident company who's actually carrying out their activities for the contract in Malaysia. So once it is confirmed that all the employees have paid their taxes, then the 3% will be actually refunded back to the company, right, to the non-resident company. Okay, but this is actually sort of a let's say, for example, now the chargeable income of the non-resident company for this contract was, say, 1 million. Okay, so let's say the contract, the tax liability for a non-resident company is 24%. So let's say it's 240,000, and let's say we have actually deducted 10% equal to 200,000. So the non-resident has to pay only the balance of 40,000. Okay, because we already collected, right? We already collected 200,000, right, under the 107(1)(a), the 10% portion. So we already collected, right? So since your tax liability is 240,000, you only pay the balance. You only pay the balance. Okay, and the 3%, don't worry, will be actually refunded to the non-resident, but we will need to ask you how many employees you had in your contract. Let's say you had 12 employees. So give us a name, right? Give us the tax reference number for that, each of those employees, right, who are working the contract from, say, Japan, and give us the amount of income and how much of taxes they paid, and give us a copy of the payment receipt, right, the receipt of the payment that the non-residents' tax liabilities have settled. Okay, then we'll refund back the 3% here. Okay, the money belongs to the non-resident company, right? It's your money, you worked hard for it, right? So we'll refund the 3%. Okay, but typically in the contracts that I was involved when I was working for my accounting firm, most of the chargeable income for a non-resident was zero, right? So there's always a refund situation whenever it came to contract payments. This is, of course, I'm talking during the 80s and 90s. Maybe today it's a different story. Okay, different story. Okay. Now, another type of withholding taxes is actually caught under public entertainers, right? So there the rate is 15%. And here, here even for 1 hour, say, for example, if Beyonce comes and gives a 3-hour concert and she's paid 1 million, then that would be actually caught under the public entertainers, right? She's a public entertainer, so she's carrying out business in Malaysia under Section 12. So therefore, she is there's a withholding tax of 15%. Right. So normally for public entertainers, for example, like motivational speakers or like, for example, famous sports personalities, like, for example, Tiger Woods or singers like Beyonce, we would actually go to this government agency called PUSPAL, PUSPAL, where we need to actually apply for a work permit. Right. So this, so when we are applying for this to PISPAL, they would actually deal with this withholding tax issue also. So this issue will be actually dealt with before the work permit is issued, right? And also, I remember going for a concert for this one very famous Australian guy called Nick, N-I-C-K, Nick, right? He doesn't have arms, right? But he was actually giving us a speech, right? And we paid him 25,000 Malaysian ringgits, right? So he was actually motivating on how to do things without 2 arms, right? And he was really very motivating. Okay, so this public entertainer, again, there was this major changes in the definition of public entertainers, where they've actually now included motivational speakers, right, as lecturers. I think it actually includes even the word, I think that the word I think the word clown is also there, right? So it's actually a very interesting aspect. Okay, and the last item we have is something called casual income. Now, this is actually those income that is not regular, right? So it's a once in a while type of income. Okay, so one example given to us in the public ruling for this was that is actually covered under section 4 small f, right? So if you look at section 4, if you look at section 4, it actually has various classifications. Section 4A is relating to business, 4B is employment, and then this item called 4F, which relates to other income, right? So other income, such as say paying commissions. Okay, so let's say, for example, now there's one. Let's say I'm a manufacturer. Let's say this. My company's name is MIA Manufacturing Sdn Bhd, and I manufacture tiles. Okay, so I've got a lawyer in Taiwan, who's calling me and saying that I'm going to introduce a customer to you in Indonesia. Okay, he's calling me. He's either emailing me or he's calling me. He's not providing any services here. He's calling me from Taiwan and he's telling me, I've got a customer in Indonesia, right? If I introduce the customer to you, will you pay me a commission? So I will tell them, as long as I sell the goods to my customer, and as long as I receive the money, I will give you the amount of commission that is agreed. So let's say the commission was, say, for example, let's say 5%. Okay, so let's say there was a 1 million transaction and I received the 1 million, right? The MIA Manufacturing, the supply of the goods received the money of 1 million. So now there is a call coming from Taiwan. Hey, remember I called you last time? Remember I sold the goods, right? Remember you agreed you pay me 5%, can? Okay. So did you receive the money? Yeah, I received already. Okay. So when we are making this payment of commissions, right, it is not specifically provided for in section 4A. Okay, it is not provided for in 4A. Okay, we need to check and see whether it could be actually regarded as casual or ad hoc or once in a while income. Okay, so will there be a withholding tax of under 109F at the rate of 10%? It depends. Okay, so what does it depend on? It depends on whether the non-resident is carrying out this introduction of customers as its normal business activity. Okay, now if he is telling me that he is providing his business as a legal service provider and he does not introduce customers regularly, he only does it casually, then we have to deduct 10% when we make the payment of commissions to the non-resident. Okay, but let's say, for example, he says, no, Ravi, I'm not actually. I also provide. I've also got I've got another company, right? I've got an ABC Taiwan marketing company who provides this introductory services, and that company will be issuing the invoice to you. In that case, you are saying that it's part of your business activity, then there is no withholding tax under 10% of under 109F. So 109F, right? The capital F for France does not apply. Okay, but before you say no withholding taxes, in the public ruling issued by the IRB for your 4F, right? Your commissions and the other income, it's called other income, right? Under 4F and 109F, the IRB actually is going to ask you for some documentary proof. Okay, so the examples given in the public rulings, you need to get the copy of the Taiwan company's audit report. right? You need to get a letter from the Taiwan company's auditor to confirm that it is their business. You need to give a copy of the contract, right? And there are maybe certain documentations that may be additionally required before you say no withholding tax under section 4 small f and 109F. Okay, now remember, the services are not performed. It's got nothing to do with the services, right? We are making a payment of commission to, so things like guarantee fees or commissions that we make a payment, right? So all these commissions will be considered to be revenue in nature, and it depends on whether they're carrying out as a business or not. Okay. Yeah, so let me just stop for a while and just let me wrap up this point. Okay, so a few questions here asked. Yeah, I think so let's go through this, huh? There's this question on what do we call it? Yeah, so now generally speaking, the IRB has actually taken the view that for software, if it's a payment for the use, so if you look at the definition of royalty, right, the definition of royalty was actually enhanced in 2017, right? There was this major change in January 2017. In fact, on 17 January 2017, they amended the royalty definition. So if it's a payment for use of software, then there is a withholding tax, right? So it's covered under royalties under 109. But if it's a purchase of a software, then there is no withholding tax, right? So now you're asking me for my view, right? My view, right? Now, when you're making a payment, right, your contract must be able to demonstrate that it's a pure purchase, right? Now, if the contract actually states that even though you're calling, the invoice is calling as a purchase, but it is relating to a payment for the use, then 109 applies. Okay, so to answer your question, it actually depends on the agreement or the document that you have, and you must examine this because it is actually quite a very sensitive issue, right? So according to you, it's a purchase of software, right? So purchase of assets is not subject to withholding taxes, like we already discussed earlier. But on whether it is really a purchase or a payment for the use, okay, payment for the use, that that depends on the agreement. Okay, so that right now there's this agent distributor. I think there's sufficient information available to you, and you can actually refer to the right. You can refer to right now. Yeah, so the payment for the use, right? So if you look at the definition, right? So if you look at the definition, there is a definition given to us in section 2 of royalties, right? So definition, it says that the payment for the use is within the scope of royalties, and there will be. Now, what's the difference between special loss of income and public entertainment? Now, public entertainment has got something to do where there's some kind of public event, because it's very important, right? It's very important to make sure that you get this right, right? See, it's a very good question you're asking. You see, the reason, why is it that I have to worry, right? Why is it that I have to worry, right? See, why do you have to get it right, right? So let's say, for example, in Malaysia, I had only one rate, right? Let's say I had only one rate. Like all payments are subject to withholding tax, only subject to 10%. Then it does not really matter. It is 109, 109B, all right, 107A, right, 109F. It does not really matter. But unfortunately, it is not, right? Most of it was 15%. They reduced some of the, like, for example, 4A, 109B was now reduced to 10%. Okay. So now the question is whether it is a public entertainer, you need to get it right. Right? So generally speaking, if you look at the word public, right, it connotes. So if you look at the public ruling, it's a very good question, huh? But the information that you want is available in the public ruling relating to public entertainers. But generally, there's some kind of international connotation that the person who's speaking is at it, is conducting at an international or an event that is open to the public. So generally speaking, if there's a motivation talk given in an international event, then in that case, that would be considered to be a public entertainer, and that would be having different implications, right? So, for example, if you have a public speaker who's coming to give you in your own office premises, right? Is during a management talk, he's actually giving you a speech. Now, that would be considered to be falling under providing service under 4 capital A. Okay, that is a question that is asked, right? And then. Yeah, okay. As far as the documentation for the you're referring to the non-resident, right? So non-residents. So non-residents, when they have a documentation, we would actually come up with a list. So let's say, for example, if it is the 3% refund, then we would actually come up with a list of employees and the details of tax paid, right? And then we would actually submit it to the IRB. Yeah, and yeah, so in this case, if it is, see here, now there's another question that is asked on if the non-resident company has no PE in Malaysia, right? If a project is not exceeded, right, not exceeded, and yeah, so in this case, now this is another question that also can happen, right? So let's say, for example, you enter into a say a 4-month contract. Right? Let's say, for example, I enter into a 4-month contract, and so it's a short-term contract, so it's not creating any PEs, or there's no place of business here, there's no branch, right? So when you're carrying on the activities, you're subjected to withholding tax under 109B, 10%. Let's see in the non-resident doesn't have a very good treaty with us, so we apply 10%. But let's say, for example, under the you're not creating a PE, but let's say, for example, now you actually exceed the, say, 5 months or 6 months. Okay, so now here, this 6 months that you've mentioned, right? I need to actually deal with it right now. Okay, I need to deal with it right now. Okay, I want to highlight one issue to you. Okay, that is very important that you might need to look into. Okay, so there's this not exactly new, but it's quite recent. Okay, this recent technical guideline that is issued by the RB, which is actually very important to make sure that you understand. Okay, so I will actually now I will actually go through this with you briefly, right? So it's called the guidelines on the application, right, in determining what we call a place of business. Okay, place of business. Okay, so let me go and access that POB, right? So let me access that POB. POB, where's POB? POB is here. That's POB, baby. Okay. Now this is actually sometime, right? It's not exactly new, but it's relatively new, right? So it's what we call this place of business, and it's actually extended by what introducing this section 12 sub 3 and 12.4, right? Now here, the 12.3 and 12.4 was actually not was not very clear. Okay, so here, if you notice under this POB, and if you look at 12.4, there's this list, right? So if you have a place of management, means you have a POB. Okay, if you have a branch, it means you have a POB. Okay, if you have a building site or construction, but they don't tell you how many months. So if I go to section 12, if you go to the Act, right? If you go to the Act, sorry, 1 minute. Listen carefully, huh? Yeah. Okay, so this is the Act. Okay, sorry, I'm talking about the 12.3 and 12.4 is given in the Act. And so they've given us a guideline on the explanations for what is in the Act, right? So the Act says POB means, doesn't mean it includes a branch, right? And then they go on and say it includes a BSCIA or assembly project, okay? But they do not give you the number of months. So if you go to the Act, if you go to 12.4, right? If you go to 12.4, right? If you go to 12.4, if I go to 12.4, sorry, I'm in Tamaf. Okay, just a bit slow. So if I go to 12, right? So it's called the derivation rules, right? And also this one, you got to be careful because the reason why you need to be careful is there's one 4-letter word, right? Called deem. So it's a deeming provision. So section 12 has got certain elements which are deeming. Okay. So 12.2 is here, 12.3 is here, and then 12.4 is here. But here 12.4 says, oh, by the way, you have a BSCIA, then it includes a POB law. Okay. Then they say, oh, by the way, it includes the supervisory activities, but they do not tell you how many months. Right. So here we need to be extremely, extremely careful. Right? It's extremely careful. Okay. But the guide actually goes on to say, oh, by the way, the BSCI that we are referring to in here, the BSCIA, remember the supervisory activities in the building site, right? The building site. Here, they are telling you, so in the guideline, they tell you, if the person has carried out activities at the site or project for a period of periods exceeding 5 months, right? Okay. So now you remember, in fact, when you wrote that sentence, you wrote that exceeding 6 months. Okay. Now you are safe. Why? Because you may be dealing with a person who's having a DTA, right? But if you're actually transacting, or the person, the non-resident is actually from a jurisdiction that does not have a DTA, then if it exceeds 5 months, then 107A applies. Okay. And if it does not exceed, then 109B will apply, right? But then they go on to say, oh, by the way, if you have a DTA, okay. Okay, so agent pun, they also tell you, okay, agent means, generally speaking, if it's dependent means it creates a POB, but independent agent, there's no POB. Okay. But here they've actually gone on to say that where you have a DTA, then you rely on the DTA. Okay. So, okay, so here to make it very simple, if you have a DTA, okay, so if you have a DTA, let me just show it to you. It's easier for you to understand. Okay, so here, if you have a DTA, right? Now, if the non-resident is a tax resident with DTA, then you can refer to the DTA. Okay, so for the DTA, let's just take an example, right? So we go to the IRB website, right? I can go and use a DTA. Let's say I use a DTA of, say, let's say I go to Singapore. Okay, so here there's a definition, right? So this is the OECD model. So this OECD model has got certain articles. So if we go to article, for example, 5, then the DTA will tell you, right? This P includes, right? So if you have a building site or construction that is more than 6 months, then it creates a P. Okay, but now coming back to the question, so let me finish the question now. It's a very good question. Okay, so let's say, for example, now somebody from Singapore comes to Malaysia for a 4-month contract, no PE. Let's assume no PE, but his contract is delayed to 7 months. Okay, so until, right, so you will continue 109B 10%, right? But the minute you exceed and have a PE, then you apply the 107A. The 10 plus 3%. Okay. Okay, Fong Han, yeah. So that is a good question. Okay, so now a refund done. Okay, so that is that is crossing. So from 109B, you continue to pay a deduct withholding tax on 109B, then you move to 107A. Okay. Okay, so now let me go back. So I've already finished those questions. Okay, and before we have a short break, let me just wrap this up. Okay. Right, we'll have a short 10-minute break at 10:50. But let me now another major issue that was actually established is there was no more regrossing, right? So if the Malaysian company is pay withholding taxes, okay, it depends on who is bearing the withholding taxes. Okay, so let's say, for example, here, let's say, for example, I'm now entering into the Malaysian company is entering into a transaction, right? So let's say, for example, there's this company called a non-resident company called NW, right? Based in South Korea, and they were providing services, and all the services were performed inside Malaysia. Okay, they were providing services, and they were providing services inside Malaysia. So therefore, the whole amount of 150,000 is subject to withholding taxes. But the non-resident has decided to bear the withholding taxes, right? So the tax is borne by the person receiving the payment, right? So the payee is deducting. So we will actually pay this 135,000 to the non-resident, okay? And let's say, for example, we make this payment, right? We make the payment to the South Korean, this NWP Private Limited on 8th of May. Okay, on 8th of May. Another major change that took place was the due date is within 1 month of paying or crediting the non-resident. So if I pay on 8th of May, then the due date is 8th of June, right? Now, previously, it was actually reduced by 1 day. So that means if it's 8th of June, then the payment is actually due on 7th of June, right? So if you paid on the 8th, the IRB would have charged you a late payment penalty, which is equal to 10% on the unpaid withholding taxes. Okay. So that is also a change that is actually established in the recent public rulings. Okay, in the recent public rulings. Okay. Now, the exemption order that I was referring to must meet all the requirements under this exemption order. This is 2017, right? This number 9 exemption order. This 323 2017. Now this exemption only applies for section 4A1 and 4A2. 4A1 and 4A2. So it does not apply for the rental or mobile properties. Right, so if the non-resident is actually is subjected to withholding tax under rental or mobile properties, then this exemption order doesn't apply. So that withholding tax will still apply if the income is deemed derived from Malaysia. Okay, but let's assume now the non-resident company, the South Korean company, actually says, I'm not going to bear the withholding taxes. Right, so if I issue an invoice for 150,000. You have to pay me 150,000. So if my invoice is 150,000, you have to pay me 150,000. So therefore, in this case, the withholding tax be borne by the person who's making the payment. Okay. Now here we used to actually regross, but now under this public ruling, it says you do not have to regross. Okay, so therefore what you do is you take a 10% straight and you have to pay an additional 10% from your own pockets. But unfortunately, the 15,000 that you pay, you cannot get a deduction for it. Okay, so the withholding tax, right? The tax that belongs to the non-resident, in this case, the South Korean company NWP, paid by our Malaysian company, will not be allowed a deduction. Okay. Now there's a note in the public ruling that says that the date for this, right, this is borne by the payer is effective from this date, right, 5th of December. Okay, so you don't have to regross. You don't have to regross it. Okay, and also, like I said, there are certain DTAs which gives you a lower rate, right? Right, and there's a nice example given to you, right? There's an engineering company in Singapore was engaged to carry out engineering inspection and rectification works for a period of 9 months, right? So if you look at, remember the DTA article you just now saw, right? So the DTA article between Malaysia, right, a Singaporean provision shall be deemed, right? Deemed. So it's a deeming provision, right? To have a PE if it carries out certain supervisory activities in Malaysia for more than 6 months in connection with a building site. Okay, so therefore, in that case, since it has a PE, right, then it is 107A and it is not 109. 109. Okay, so ladies and gents, let us have a 10-minute break and then we'll start. We'll continue at 11 o'clock. Welcome back, everybody. Yeah, and I'm happy that you're actually awake because I thought you'll be sleeping by now, but looks like some of you are, were expecting this tax overload. Sorry, hopefully it's not overload. Tax just loading, okay lah, but not overload lah. Okay, so now there was this this question. I mean, in fact, Brian, my friend Brian, who is also here, he was asking why is this tax law so difficult, right? I think one of the reasons, I don't know whether it's really true or not, but my reason, one of the reasons I think is tax laws sometimes are made a bit difficult is because only then the consultants can make money, otherwise if the law is straightforward, then cannot make money. So some of the laws may not be as straightforward, but I think the reason is like if you go to countries like UK, for example, and India, the laws are a bit crazy. Right? I remember I was studying UK tax, and there was this date of commencement of business rules, and it is so complicated. You kept on reading so many times you cannot understand, right? But then subsequently they changed it and made it much simpler. So, so sometimes the laws are made slightly. Now there's this question on the training, right? I think Brian is asking on now if it is actually got in. You see, under the public ruling, they've indicated that if it's a connotation of a public event, if it's an international event or a public event, or the speaker is a renowned public speaker, then generally speaking, the public entertainment rules of 109 A applies, right? Otherwise, it's considered to be 109B, but of course that has to be examined based on the contracts. Right, and right, and the other point is for a 109A to and 107A. Let me just go back to my slides. Okay, just to highlight one point which you already know, but I just want to highlight. 109. Where is this? So 109A and 107A applies only if it relates to a contract in Malaysia, right? So if you're, say, for example, you're now receiving through a video a public, and like for example, say Beyonce is actually singing in Singapore and you're watching it through video, and when you make the payment, it's not going to be subject to tax because the performance is not in Malaysia. So for 109A and 107A, the contract has to be undertaken in Malaysia, or the public entity has to be performing inside Malaysia. Okay. Now we go on to the next point. Okay, and we go to withdrawal. I don't have much here, but one of the most important provisions is under this what we call 24 subsection section 24 sub 2 of the Income Tax Act. And generally speaking, if you're actually carrying out a business like what right is carrying out a business, and she is now withdrawing her stocks, right? And let's say the cost of the item is 1,000, right? And the market value is say 2,000. Then the act actually requires you to pay taxes. So there's no sale here, right? There's no sale here. So you got to bring in the market value as part of the gross income, right? So you add it to your PBT, but you can claim the cost, the deduction. You can claim the cost of the inventory or the stocks as a deduction. Okay, so withdrawal of stocks is actually very important, especially if it involves properties, right? Properties, the minute you go into properties, the value, everything goes, right, is very high, all right? So this 24(2) actually applies when there is a current, right? So let's assume that you have some stocks or inventories, and if you withdraw it for your own use, then it is then you got to bring in the market value, right? And you can claim the cost as a deduction. So you only pay tax on the profits. Okay. Excuse me. So I think that that is also now another one that is actually quite significant here is now whenever there's a compulsory acquisition. So let's say, for example, now you're a property developer, right? So property developer, let's say you're actually capturing your land as part of your inventories, right? Although the Act actually uses the word stock in trade, but right now, of course, the appropriate word would be inventories, right? So the stock in trade, right? So let's say, for example, you're capturing your land, right, that you bought as your stock in trade because you're a property developer. And if there's a subsequently there was a compulsory acquisition, right? under these major changes that took place after a lot of cases that landed up in the courts, um, um, that compulsory acquisition is actually regarded as a gross income that is arising from a business source. Okay, so generally speaking, whenever, like say for example, now you own a property. Let's say you bought a piece of land in Banting for 1 million, and you are having maybe an estate, an all-palm estate, right? So you are running an all-palm estate, and suddenly the government actually wants to build a highway. Okay, so they go to you and say, okay, we want to build a highway, therefore we're going to compulsory acquire your land. Okay, so let's say they actually pay you 3 million. Okay, that 3 million is not subjected to income tax. Okay, and for real property gains tax purposes also, there is a no gain, no loss if it's a compulsory acquisition by government. Okay, so in normal circumstances, if it is compulsory acquisition, there is no income tax, right? And there is also no RPGT, but you still need to do your filing of returns, right? Your relevant returns, but there is no income tax to be paid for you because you're holding it for investment purposes. And so capital gains are not subject to income tax. Number one. Number two is real property gains doesn't apply because we have the specific provisions under para 3, which says that if it's a no gain, no loss will be treated, applies if it's for compulsory acquisition, right? But if it is relating to a person who is capturing their land as their stock in trade, such as a property developer, very sorry to say, even though there is no business transaction, right? Because in order for a trade, there must be a willing buyer and willing seller, right? So the element of compulsion actually vitiates the trade. So under normal rules, whenever there's a compulsory acquisition, there is no trade. For income tax to apply, there has to be a trade, there has to be a business, right? So this controversy was actually completely settled as a result of the major changes that took place in 2014. Okay. Now there's something on repairs and renewals that based on a public ruling in 2019. There's nothing much I want to say here, right? But you got to make sure that when you are carrying out your say you're preparing the tax computation or reviewing a tax computation, you got to analyze the repairs and maintenance expenses in your profit or loss to see if it is any, say for example, if it is say repairs that of any repairs, right, or renewals, right, and if it is actually say any reconstructing or rebuilding or upgrading or modification, right, that would be capital nature, right? So it may be eligible for capital allowances, but you cannot actually claim, you cannot claim, right? Now, some of the points based on various case laws that is developed over the years. So where there's so now in your argument, so let's say for example, now you're carrying out your major repair, right? That's costing you say maybe 100,000 or 50,000, right? So generally speaking, if the IRB actually notices that the amount is very huge or significant, right? Like for example, a simple example would be, let's say for example, you buy a lorry, right? You buy a lorry for 200,000, it would be capital, but when you cost of maintaining the asset, right? So your cost of maintaining the assets, such as your servicing, is revenue in nature. So you actually replace a small part, right, of a large asset. Okay. So that concept actually you need to analyze for each of the transactions of the expenditure that you or expenses that you incur. Okay. So if the repair is to restore the assets to the original condition and it's incurred in maintaining an asset, right? And it has no element of improvement. Okay, now this is very subjective. Okay, the minute you go into a subjective area, you better be well prepared. Okay, now I'm not going to give you advice. I'm not here, right? I'm going to tell you now on behalf of MIA, I'm not going to be here giving you advice. I'm not here to give you advice. Right, I will actually just explain to you what are the elements that is found in the Act and also based on case laws. Okay, but I can also share some experience with you, right? So if you're going to have an item which is of significant impact, you got to prepare a information pack. That means you got to provide a written supporting information saying that why this expense is not capital, it is revenue, right? Now, if you actually spend some time actually preparing that summary so that you can actually give it to the RB during a tax audit upon their request, then it looks as though you are very genuine, right? It looks as though you are trying to help yourself to make sure that you are trying to follow the law, right? So if it actually arises from a technical adjustment, right? So let's say, for example, there was a repairs and you treated it as revenue and you did not actually disallow it, you claimed it, but the RB said, no, it's capital, so therefore you cannot claim it and disallowed it. And so that resulted in a additional tax, right? So that there was an additional taxes doesn't end there, right? So there could be additional penalties for submitting incorrect return, right? So if it is on technical grounds, right? And if there's an element of good faith, right? Even though you may have that element of good faith, the penalty may still apply. Okay. Now, based on certain case laws, I've also got some case laws on that also. We noticed that even if it's a technical adjustment, if it's a genuine mistake, right, the RB will insist on charging you penalties for submitting an incorrect return. Okay, but by you taking these steps, like for example, what steps do I have to do? Okay, there's the repairs that we undertook for our factory. It cost us, say, 85,000. Okay, now we are treating it as deductible, and these are the reasons. Okay, you come up and throw in some case laws, right? Maybe some Samuel Jones, or maybe some Bullcraft doesn't apply. O'Grady Group Bullcraft doesn't apply. Samuel Jones apply, right? So you actually come up and do things to help yourself, right? So that the RB actually likes it. Okay, they say, okay, this guy Ravi, he looks he looks as though he's quite genuine law, right? But right, so he looks as though he's not trying to cheat the government, right? He's not trying to violate the law, right? But it's actually quite a subjective area. Okay. So if you can actually say that there was no creation of a new asset, okay, if you can actually ensure that the repair actually did not have any significant alteration to the character of the asset, there was no improvement to the asset, there was no increase in value of the asset, right? So all that has to be documented. Okay, has to be documented. Okay, so in the public ruling, right? Let's say, for example, SB. Right, provides railway services that carry passengers to enjoy different sites, right? And they perform repairs and maintenance, right? To ensure that the rails and tracks are in good condition. And the company actually discovers that the rails had been damaged and were dangerous. Okay. So the rails could not be repaired, but instead the company had to replace them. Okay. So this replacement, they regard it as a deduction, right? Now, generally speaking, when you use the word replacement, it is quite sensitive. Right. So replacement, you got to be careful. OK, but the expenditure for replacing the railway is considered to be revenue. Right. It is repair. It had no element of improvement. Right. But instead, the replacement is to restore the railway to its original state. Right. And to allow the company to continue generating its revenue and is not to create a new asset. OK. So if you notice, generally speaking, when you look at the tax computation, if you say repairs and maintenance, and it includes a replacement of tiles, right, for your factory, right? So you need to do a deeper analysis, right? And if you can come out with something like is given in this public ruling example, it may help the taxpayer. Okay, it seems to say that there's this quality, right? But ladies and gents, I'm going to warn you, you better be ready for a challenge. Okay, so always get a good lawyer and a tax agent. So always buy your accountant, your tax agent, and your tax lawyer lunch at least once a month. And then they'll do a very good job for you. Now, there's this issue about the lifespan of 2 years. Okay, lifespan of 2 years. So now, generally speaking, all as you know, capital is regarded as if it's supposed to last at least for 12 months, right? 12 months, at least 1 year is considered big capital. But there are certain provisions that provides for certain special unique treatment where the asset has a lifespan of either of less than 2 years. Okay, that means it's either 2 years or 2 years or less. Right, 2 years. That means not more than 2 years means either 2 years or less. Okay, so again, the guideline is actually given us. The public ruling is given us a guideline on that. Right, a guide on that. Now, so let's say, for example, now you are operating a restaurant. Okay, you're operating a restaurant, and you're buying this glasses, right? So you're buying this glasses, plates and glasses. Now that is considered to be having a lifespan, right? So we don't know how long that will last. Right, your plate might last you for at least 5 years, right? But it may last you, right, for 1 day, right? So because of that kind of contradiction, right? So the general rules for this would be, it is considered to be an implement or a utensil or article with a lifespan of less than 2 years, right? So in that case, the treatment would be, so let's say you bought 100 plates. 1,000 ringgit, right? So in YU 2021, you operated a restaurant, you bought 100 plates, you paid 1,000, you cannot claim on the purchase. Okay, but let us say in 2022 June, right, on 23rd of June, there were 10 plates that broke, right? On replacement of that, it has a very unique treatment where you treat it as a revenue expense, right? You can claim it as a deduction. Okay. So examples would be your plates and glasses in a restaurant, right? But if it's a steel a plate or a steel utensil, and that is not that is going to be more than 2 years. Okay. Okay. So now let's go to something on debts. Okay. Let's go to debts. Right. So here there's nothing much here. I have for you, nothing much. But there are some wordings that I want to highlight to you, right? There are some wordings I want to highlight to you, okay? So for a deduction, it has certain elements, okay? Okay, so the first item is it must be trade in nature, right? It must be trade, right? So that is number one. Number two, it must be part of the gross income. Okay, so if so say for example, A Sindang Bahad is actually now having a debtor called Shell Malaysia, right? And we sold goods to Shell Malaysia for 1 million, but the customer was not paying. In that case, that would be considered to be a trade debt, provided it is reasonable. So the wording they've used in the Act is, it is reasonably estimated to be irrecoverable in accordance with section 34 sub 2, okay, or what we call subsection 34.2, okay? And it need not be wholly, it can be either wholly or partly, right? And you can claim a deduction, right, against your gross income in arriving at your adjusted income, okay? And but where a trade debt is actually written off as bad, right, and has been subsequently received, because then that would be considered to be as income that is subject to tax. Okay, the gross income would be taxable, right? Taxable. Okay, so here we notice that if it's a non-trade in nature, and if it is not part of the gross income, then in that case, so if it's not trade in nature, then it is not deductible. And let's say, for example, now you are taking over some debts of a related company. Right, you're taking over, let's say you actually took over some assets, including some debts. When you subsequently write off, of course, you cannot claim because it is not part of your gross income. Okay. Yeah, and here the IRB has actually made some very important to us. Okay, so they want you to have a summary. Okay, so they want the credit controller, right, or the person, the finance manager, whoever is responsible, to have a summary, okay, of your debtors. Okay, so for each debtor, right, you got to tell how many reminders you have sent. Okay, if you have entered into a debt restructuring program, show me the program. Show me a copy of that agreement and attach it to the summary, right, which the credit controller is preparing for you. Okay, so the credit controller is responsible, or the finance manager will be responsible to ensure, right? So this is important. Or if there's any dispute, right, and if there's any legal action, you attach a copy of the legal action notice to the tax computation, so that you will actually preparing a file, right? So for debtors written off, right, or provision for the allowance for debts, you would be having this sufficient documentary proof. Okay, so if you've got calls, right, so normally they actually expect the credit controller, the person responsible, to sign off on the agreement on this summary document. Okay, so the summary document will be reviewed, right, and there will be a sign off, right, and the IRB would actually would like to see the person who is who's actually preparing this document, right, and then so that will be right. Now, if it is and the guideline, they've actually said that if reasonable steps have been taken, right? So what are the steps you have taken? What are the reasons for the provisions, and what are the steps you have taken? So one of the examples they've given is, if the debtor has died, then it's a good reason you can claim a deduction, right? Or if it's evidence of bankruptcy or liquidation or winding up, right? Or if it's statute barred, or if it cannot be traced, right? And attempts of negotiation and attempt. And also another good example is whether it's justified or not, right? Let's say, for example, now my Shell Malaysia owes me, let's say 3,000 ringgits, right? So if I write to my lawyer and say, hey, can you issue a letter of demand to my customer or not? And he's going to charge me 5,000 for it, right? Or he's going to charge me 2,000 for it. Then it's not justifiable, right? It's not justifiable. So even though there may not be any legal action, you did not take the action, because it might as well don't recover the debt, because instead of me trying to recover 3,000 and I pay 2,000 to my lawyer, I might as well just don't say thank you to lawyer and nice talking to you and put down the phone, right? No point wasting my time, right? Because it's not efficient, right? So that is also another reason which is acceptable. Right, so the cost of recovery is more than the cost the debt. Now, another point that we need to highlight is if there is an element, yeah. So there's this this forgiving, right? So let's go through this example. So with the tax rules, we go through this example, right? So there's a company called F, right? F is negotiating to take over one of the subsidiaries G, right? And by a consortium, right? So at the request of the consortium, and in order to facilitate the deal, the directors of F decide to forgive a debt, right, on account of goods and services supplied to G amounting to 100,000. Okay. So a letter to that effect, enclosing a copy of the director's reso, is issued to G, which then proceeds to extinguish the debt, right? As at 30th September 2017, right? So in the accounts for 30th September, F writes off the amount as a debt, bad debt for F, but when that bad debt was written off, it's not going to be allowed a deduction, right? Because it is not from a commercial consideration, right? Because the reasons was not in the ordinary course of business, right? On the basis of considerations other than the likelihood of recovery, right? So for G, the amount of debt forgiven will be reflected as amount that they did not have to pay, right? So where the amount has been added back is subject to tax, right? The amount being a reduction in the cost of goods and services previously charged in full in the income, because it actually relates to your the debt was actually used for on account for your revenue transaction. So therefore it is taxable. So non-trade debts would be debts that are written off as bads, right, in respect of non-trade debts, right? Like, for example, your employee takes a loan, right? Your supplier takes an advance, your customer takes an advance, right? Those would be considered to be non-trade, right? Unless, of course, it happens in the ordinary course of business that you give loans to customers, right, as part in the ordinary course of business, then you can argue on the famous Reed's Brewery case that you can claim a deduction, right? But generally speaking, it's considered to be non-trade, right? Especially if it is a employees taking loans, right? So debt due from related or connected persons, right? It's viewed as not made, right, in the ordinary course of business, is not for valid business or commercial considerations, right? Unless there's evidence to prove, right, that it is made at arm's length and for valid business or commercial reasons, there must be good evidence it is not having an element of private or personal or other non-commercial considerations, right? So if you're willing to do that, especially some companies like some MNCs, I know that, in fact, the MNC that I worked for, even they were saying that you got to pay more attention to your related companies' debts than your customers, your third-party debts, right? Because why is my own company not paying me, right? So that is also quite okay. Yeah, and also, and the public loaning also goes on to say that where there's a settlement of a trade debts with assets. All right. So if there's a debt that may be settled by the foreclosure of an asset held as security, right, given in exchange for the debt, right? So in such a case, the net proceeds from the sale of the asset or the market value of the asset is to be taken as the settlement for the debt, right? So any balance of the debt is still outstanding can be claimed as a bad debt. Okay, and here I have not much of information here. I just want to have a quick, yeah. So in this public loaning is also quite interesting. It's called the tax treatment of any sum received and debt owing that arises in respect of services. So we are only referring to services here. And this service is actually covered under section 24, 1B. Right. So if you go to the Act, if you go to section 24, it actually tells you about gross income from business, which includes for debt arising from sale of goods, right? And yeah, so it was amended for a debt owing to a person, right? And 24(1)A provides that any sum received by a person, regardless there's no debt, right, in respect of service rendered or going to be rendered, right? So if you've received advance income, right? So let's say, for example, you're providing legal services, and if you've received advance income, right? Let's say, for example, for 2 years, let's say in 2022 and 2023, you received, say, 200,000, 100,000 for 2021, sorry, 2022, and 100,000 in advance as part of your deferred income or advance income, right? So in this case, the amount for that arises in respect to the services going to be rendered is going to be treated as part of your gross income from a business for the relevant period in which you received. Okay, so let's say, for example, there's a nice example here. P signed a 1-year contract valued at 5 million with A, right? And for services rendered to be rendered by A. Okay. For the period 1st Jan to 30th December. So according to the agreement dated 1st of April, P is required to make monthly advance payments from May to December, and A closes accounts 30th December. And then if the payment is not paid in 2019 with the date specified, then the debt owing that arise have to be it's yet to be rendered as part of treated as a gross income of A's business for 2019, right? So a debt owing would arise when a liability to pay exists on the date, right? So even though it is actually not relating to 2019, if you have received an amount that relates to an advance payment you need to go and check your balance sheet, right, as part of your other creditors, and for tax purposes, make an adjustment. Okay, make an adjustment. Okay. Yeah, so I don't want to go too much in that. Okay, let me just quickly go through this. Okay. Let me just check and see if there's any. Okay, there's one question here. Yeah, now if it is actually withdrawn, right, stocks withdrawn, right, then it will be falling under section 24.2, right? If it is stocks withdrawn for own use, then 24.2 applies. Okay. Okay, so in this case, now if you're actually now, so now in this case, yeah, maybe we can actually discuss the Mercedes-Benz case, right? The Mercedes-Benz case. Now, let's say, for example, we have say that, for example, we take Mercedes-Benz. Okay, so if you go to their showroom, you will actually notice there is this new section, two sections. One is new cars, and the other one is called pre-owned cars, right? So this pre-owned cars has got a very unique treatment, right? So here, what happens is they will sell the same car. Say, for example, you're buying an SUV for say 300,000, right? But if it is actually a pre-owned or it's used as a demo car, right? And then you subsequently sell it to the customer, let's say at a discounted price of say, instead of 300,000, you charge them say 280,000. Okay, because it's a pre-owned vehicle. Let's say it's used as a demo car. Okay. But one of the requirements is they need to so Mercedes-Benz will register that vehicle in their own Mercedes-Benz name and utilize the car for at least 1,000 say kilometers, and then actually sell the car and then hand over the keys to the customer, right? The buyer of the car, right? Now, in this case, was there withdrawal of stocks, right? So the IRB actually took the view that the customer, I mean the Mercedes-Benz was actually using it for own use, right? Since it is registered in their name, right? But then it is actually forming part of the stock in trades, right? So in that case, they successfully argued in the Court of Appeals that there was no withdrawal of stocks, right? So in this case, it was purely a campaign. It is a very attractive campaign to sell cars, right? It was not actually used for own cause. Although it is actually registered, it was sitting in part of the stock and trades, right? It is not used by the company, right? So even though it may be used by one of the company employees, right, as one of the benefits, but it was eventually decided in the Court of Appeals that it was not stock and trade, and 24.2 did not apply in the famous Mercedes-Benz case. Now, this is a Court of Appeal case, right? So if your situation, Fong Han, is similar to that kind of situation, then that would be you can actually, if it is actually having similar characteristics as Mercedes-Benz, then in Mercedes-Benz case, there's no 24.2. Okay, but it's a very important point for you to consider. Okay. Yeah, and yeah, there's this yeah. So like what Brian is saying, there's this small value assets, and you can actually claim at a very special rate of 100%, right, Brian? So that is correct, but we don't actually consider it to be an asset of a lifespan of 2 years or less. Okay, so that is got capital allowances. Yeah, so in this case, yeah, so in terms of these small value assets, so if you're buying say, for example, the air conditioner for say 1,500 ringgits, right, you can actually claim, right? So regardless of who you are, you can actually claim it, but there are certain restrictions for small value assets. If that benefit of 100% of the cost can only be enjoyed up to a value of 20,000, right? If you are not an SME. If you are an SME, then of course you can, there's no limit. But if you're not an SME, then you can only enjoy this 100% special treatment of annual allowances of 100% only up to 20,000. Okay, so the limit does not apply if you're an SME company that qualifies, right? And we'll talk about SME companies later. I've got some notes on that. Okay. Okay. Now regarding this, what's this? Yeah. What's this? Regarding what the debt recovery. Of course, if you're talking about SST, if you've claimed the deduction for it, so the same example is sales tax that you paid over to customs and you actually subsequently recover it, and subsequent recovery from your customer, that would be actually now that amount has to be paid back to the customer, right? So for SST, you got to account for the debt. Yeah, so you see, it's a good question. See, now, how do you determine the market value? Right? Typically, the IRB would actually expect you to carry out a valuation by a professionals. Okay, so if it's for an asset, it's a bit straightforward, right? But if it is for a typical market value determination, then the IRB will expect you to actually get a valuation done by some professional valuers, and which is acceptable, right? So that also is very important, right? And yeah, you can actually treat it as a independent sales, right? Assuming, but if it is actually involving, say, for example, assets, we do take a professional valuation done. Okay, okay, so that actually clears the question so far. Okay, so now we shall move on. I don't really have much here, so we don't have to spend too much of time here. Okay, so there's this summary given to you. Generally speaking, we have a very good public ruling called Appeal Against an Assessment, which is constantly it's called Appeal Against Assessment and Application for Relief, right? And it's public ruling number 7/2020. And let me just summarize it, and we will talk about case laws later after lunch, but I want to highlight certain issues. But generally speaking, we have appeal provisions available to an aggrieved taxpayer that's given to us under Section 99. Now the DG is actually given anything between 12 months to 18 months to review the case. So typically, if you don't agree with the DG, right, there's this disputes resolutions department that goes to, but again, it is actually decided, it is between, you know, the revenue officials. And assuming now you want to now take it to the special commissioners, right? It's going to cost you about 20,000 if your tax agent and your revenue lawyer is in a good mood, right? But if it's not a good mood, then it can be anything between 20 to 30,000, right? Per appeal. Now, the special commissioners of income tax is not the courts, right? It's actually an appellate, a bunch of people with experience who's going to look into an appeal. And most of them have got various experiences in the judicial matters, right? But it's not the court, right? You don't enter the court system when you make an application, right? So when you make a preparation of a Form Q, you are actually addressing it to the special commissioners of income tax, right? So when you're preparing a Form Q, so let's say, for example, now you are making an appeal, you receive an additional assessment and you're making an appeal, right? You're making that appeal, you're preparing the Form Q and addressed to the special commissioners of income tax, but it is handed over to the Director General of Inland Revenue for them to make their decision before it is handed to the special commissioners, right? So the DG actually agrees with the taxpayer, then we don't have to go to special commissioners. Okay, so special commissioners is still not very expensive, but
let's say, for example, one of the parties, either the DG or the taxpayer disagrees, then we have recourse to the High Court. Okay, now you're going into the court systems. Right now it gets a bit more serious, right? And I think you know what's the meaning of serious. Serious means it's going to cost you more money, right? So make sure, like I said, let me remind you, always buy your accountant, your tax agent, and your revenue lawyer, especially your revenue lawyer, lunch at least once a year, right? So now, so that could cost you anything between 50,000, right? So 40,000, 30,000 possible, right? And let's say, for example, now it goes further up to the Court of Appeal, right? So the last court, a recourse for cases that goes through the Special Commission of Income Tax is the Court of Appeal. Okay. So you cannot go any further than Court of Appeal. So the Court of Appeal is actually the final appeal possible, right? But we've had many cases where the taxpayer did not want to go to the special commissioner. So they applied to the judicial review, right, through a judicial review process to go to the high courts direct, right? So because they went to the high courts direct, those cases can be appealed to the Court of Appeal, right? So your step will be either High Court, Court of Appeal, and Federal Court. Okay, because you did not go to the Special Commission of Income Tax. Okay, now the courts are actually taken the view based on what I've got some notes which I want to show you later after lunch, but generally the courts have actually taken the view, exhaust all your appeal procedures, go to Section 99, right? Prepare the forms, right? Now sometimes you do not actually go through this process because it takes a lot of it's very unfair. The law that the administration that is actually undertaken in this particular transaction for the taxpayer was considered to be too unfair. So that's why they actually make appeals to the High Court. Okay, but the courts are actually taken, especially the federal courts have actually always commented that go to special comm first, right? Trash out the case, right? It's good for the taxpayer, good for you also, good for us also, good for you. Right? Don't go to High Court first, right? Don't, right? But sometimes for various reasons, for example, it may be unfair, right? It may be unfair or the amount is involved is too high, right? And also the process of making appeal to stand over, right? So that is one of the reasons which they, okay. So 99 says that you're entitled to make an appeal. And I think I've got some examples here. Let me, yeah. So as Sarah is a teacher who's furnished the returns, right, on 2nd of May, and then there was an additional assessment for YA209 was made on 10th of September, right, and it was served. Let me just get it was served. Let me just highlight something in the public ruling. Okay, the date of the assessment was 10th, but it was served on 15th. Okay, in that case, the taxpayer can make an appeal against the assessment, right? Assuming that she's already submitted the Form Q. And she's going to prepare the Form Q. She's going to be doing it, right, by the 15th of October 2020, which is the 30 days from the date of service of the notice. Okay, it's not necessarily the date of the additional assessment, but it'll be the date of service. Okay, so but sometimes the services can be made through a postal, right? If it's a registered post, then that'll be the date of services. That is actually quite important. Now, another example given to us in the public was A is engaged in the business of manufacturing, and A has interest in rental income, and they furnished the tax returns on 15 June. A complied with all the PRs but disagreed with the treatment in one public ruling. Right, so there's one public ruling. There was one item in the public ruling which they did not agree, right? So therefore, there's this deemed notice of assessment shall be deemed to have been served on 15th of June. As the company does not agree with the tax treatment of the interest expense, right? So in that case, right, as stated in the right. So in this case, since you actually disagree with an item in a public ruling, then you're allowed to make an appeal, right? So there are certain circumstances where you can make an appeal, but there are certain circumstances is deemed to be final and conclusive. Okay, final and right. So section 99, right, shall only apply to appeals on notice of assessments made, right, where there's an assessment or additional assessment or advanced assessment or a notification of non-chargeability, or what we call this NONC made by the DG as a result of an audit or investigation. And then there's this very, very controversial, you know, and I've got one case where I was involved where there was this doctor who was submitting tax returns until 2018. Then in 2019, she stopped, right? And then she did not actually notify, right? She did not submit any further returns because she stopped anyway. But the IRB continued to raise assessment under what we call this best judgment assessment, right? So the IRB seems to be saying, oh, you don't know how to estimate income and pay taxes. We will estimate for you. Right? That is quite dangerous, right? So we know that, right? Now, this deemed assessment or deemed for amended TITR, where the taxpayer disagrees with the tax revenue stated in the public ruling on known stand rules or practices by DG, right? So, so in this case, you can actually, since you disagree with an treatment in the public ruling, you can make an appeal, right? But there's this section 99 appeal procedure does not apply to what we call a composite assessment, right? This composite assessment is, of course, arises under 96A, which refers to an investigation case, right? So a typical investigation case is where a taxpayer and his wife are under investigations, right? So this one is actually different from an audit. An audit is actually a known, right? So they will actually write to you, right, and say that we are coming to your offices, for example, or we're coming to see you on the, say, 2nd of July. We want to ask you a few questions for your 2018 and 2019, right? So they will notify you in advance, right? But under a typical investigation case, there is no prior notification, right? So the IRB seems to have found out that you are under declaring your income without any basis. Okay, so it might be information through an informant. Okay, so let's say, for example, if you're an informant and if you inform the IRB saying that this company ABC Sinambahad is cheating, they're not complying with withholding taxes, their purchase cost, they always increase it by 25%. Okay, and you provide the information together with documentation, you have to prepare a form. Right, you have to prepare a form, you have to attach the documentary evidence, right? State what you know, and you provide the information, you will be rewarded up to 10% of the amount of tax collected, right? Not 10%, but up to 10% of the tax collected, depending on what is the nature of the information you gave, right? And so that is actually specifically provided for in the Income Tax Act, right? It is not provided for in the GST. And if I'm not mistaken, even SST also doesn't have these provisions, but for income tax, right? So let's say, for example, now there's an investigation, right? And then there was a subsequent additional assessment of say 100,000 plus, say, penalty of say 50,000. So the 150,000 will be actually based or issued under a composite, right? Composite is made up of the additional tax plus the penalties, and then you can apply for installments schemes, right, up to 24 months, right? So you ask for 24 months, they'll give you 6 months, right? So you ask for more, and then you can get more, right? So, and you pay by installments, but the case is settled. You cannot open the case and there's no more appeal procedures. Yeah, so there's just 4 copies of Form Q. So whenever you have an appeal procedure now, it is advisable for you to prepare the Form Q, right? So even though you're going to meet the IRB officer, right, within that date of service, you got to do within 30 days, right? You already prepared the form Q. Okay, you already, so they want 4 copies. And at least 1 copy is an original form, whereas 3 copies may be copied, no problem. And then form Q and attachments submitted by the appellant must not be attached with the other documents, right? Now, completed form Q with the grounds of appeal must be submitted, right? But if it is incomplete, then they have a right to reject. Okay. Now, the date and the amount of tax payable, right, and the details of the grounds of appeal must also be. So you say that I don't agree, the interest expense is deductible, right? And it is for my business purposes under 33(1)(a), right? You should provide all the reasons, right? And then it must be signed by the appellant, right? Who's the person assessed and chargeable to tax. And if in the case of companies, the form Q must be signed by a person authorized under section. So not typically be a director. So form Q cannot be signed by a tax agent, right? An incomplete form Q shall be returned to the appellant. Okay. Now, the reason I came to this public ruling is because of this reason, actually, right? All the other information you already know, so I don't want to, right? So the reason why I came to this was this reason. Okay. So here, what they've said is, now let's say, for example, you received an assessment today. Okay. So there's a date of service today, and you receive an additional assessment for say 10,000, and you're not happy with the decision. So you go and meet, right? But you do not meet the 30 days. So your form Qs were not filed within the 30 days of the date of service of notice. Okay. So now in this case, now I want to make an appeal to apply for an extension of time to make an appeal, right? So it's what we call the extension of time. Right, so that is covered under section form N. It's covered under form N under section 100. Okay, now they've decided to actually come up and say that the appellant must furnish the form N to the DG, writing say why he could not meet the 30 days deadline, why he could not submit the form Q within the due date, right? And he's got that he can do it within 7 years from 30 days after the notice of assessment was served. Right, so if you got the notice today, you got 30 days, and if you don't meet that 30 days, then you got 7 years, right, from the 30 days. And this is applicable to Y2020, right? So let's say, for example, Q is engaged in transportation, right, and is audited on 30th September 2021. And some additional notice of assessments was issued on October 2021, right? And the company taxpayers did not agree, right? But they failed to submit the form Q within the 30 days, right? Which is due 30th November. So Q may apply for an extension of time to make an appeal, right? Make an appeal not later than 7 years from the 30 days, which is 30th November 2028. Okay, so this is actually now much better. Those days they did not have a time limit, so it can be any number of years, but now it is 7 years. And in most cases, ladies and gents, I'm very happy to inform you that the RB is quite okay with this, giving this extension of time, right? Now, another one that is covered on the public ruling is what we call this error, right? But I actually want to highlight some of the issues after lunch. In what you think is error may not be error for IRB, right? Right. So there are some provisions. So this excuse me. Okay, so this error commission such as computational arithmetical. So they're saying that instead of say 120,000, you put it as 210,000, right? So that would be a arithmetical error, right? Or arising from a misunderstanding of the law, right? Or a statement of fact or omission, or not designed by income, by design, right? Or by mischance, right? So the total income reported in the income column, right? Income of the previous YA is reported in the current year. You forgot to claim certain deductions under 45, right? Your release, for example, right? You did not claim any deductions and rebates such as your personal tax, right? So M has furnished her returns. She forgot to claim a deduction for this purchase of books, right? So she can make an appeal, right? So for Y 2019, you got 5 years from the after the end of the YA. Okay, you got 5 years. Okay, so you can claim a deduction, right, that by 31st December 2025. Okay, now A has furnished a tax return on 30th June. Right, A is in Ahmedabad, and A was furnished without claiming the capital allowances, right? So they can actually make a claim under Section 131 by the 31st December 2025. Okay, now let me just quickly check. Yeah, so there was this wait, there were some questions here. One second now. Practice how to get okay. Why the normal appeal can made up to court? No, it cannot go to the Court of Appeal. It has to go to High Court. Okay. So right, Wong. So here, if you are actually having an appeal, you can apply to the High Court, right? And apply through a judicial review process, or what we call a JR process, a judicial review process, right? To apply to the High Court to hear your case, right? Now, if the High Court agrees, right, then you can make an appeal. But otherwise, they'll actually say rejected. And in most cases, they're actually rejecting it and asking you to go to special court. Okay, so it actually depends on when you make the appeal. Okay. Yes, there was this proposal. Yes, the RB is actually very keen, right, Kumar? They're very keen on merging the Customs Appeal Tribunal and the Special Com. And there's a possibility that even the SST system, or the SST or the GST or whatever it is, and the income tax can be merged, right? Just like how it is in the UK, right? We have one body, right? And to be very frank with you, from my experiences, it is always I feel the indirect tax, the SST officers are much more business. Pro-business and more understanding compared to the RB, right? The RB tend to be a little bit straight, right? But whereas the SST, so a merger is possible, yes, and we are looking forward to that. The merger of the appeal procedures to simplify the process, right? And also to also end with the fact on the point that now let's say, for example, you're actually carrying out you're a company, you're carrying on business. And if you're carrying out a, let's say you're subjected to service tax and you're also subjected to income tax. So there'll be a tax audit for income tax. There'll be a tax audit for service tax, right? So if it's one umbrella, if it's one umbrella like in the UK, for example, then you'll have only one audit, right? So if you have one audit, means I can actually focus more on my business. Right, I can focus my resources on my business. I don't want to be, not exactly, I don't want to spend too much of time on administration. Oh, yeah, I know tax administration, very, very important. I don't know, no denying that. And I'm not going to say no to it. Okay, it's extremely important. But why don't you simplify the process, right? And that also could be something. And once GST comes in, also it's going to be very different. Under SST is much more relaxed. Once the word GST comes, the whole thing, oh my God, the taxpayers are going to suffer. They'll be paying more fees, right? So it's a lot of advantages and disadvantages. Okay. Yeah. If you beat the deadline, only you need to apply the Form N. Okay, you missed the deadline. Okay. Yeah. Yeah, and now you see, there's this question, right? Do I have to see if I receive an assessment, right, Brian? So here, now there's this provision in the law that says that regardless of whether you make an appeal or not, if you receive an additional assessment to pay taxes, whether you're going to appeal or not appeal is not the point, right? You have to pay your additional taxes, right, Brian? So that would be required. You have no choice. Okay, so now it becomes a little bit disadvantageous for the taxpayer. Okay, now the IRB cannot take you to court to recover the money. So there's an additional assessment asking you to pay 25,000 for additional taxes, or if there's any penalties, they'll ask you to pay, right? Now, if you don't pay, you say, no, I want to settle my case first. I've already lodged an appeal within the due date. So my form Q already saw it. I want to pay only when I appeal. Now here, the IRB has got no rights to take you to court, right? So the government of Malaysia, the Kerajaan Malaysia will take you to court under a civil suit. Okay, the civil suit will be undertaken by the government of Malaysia because the IRB's job is already done. I've already issued the assessment. The taxpayer is supposed to pay. If he's not paying, then it will be taken over by the AG's office, and the government of Malaysia will be instituting an action. Okay. Yes, there's a question from Ali. Right. So yeah. So generally speaking, Ali, is when you are served the notice. Okay. So the date when you are, say, for example, the IRB is actually serving the notice and say, for example, they are giving it to you, or they're actually posting it to you, right? If they're posting it to you, let's say, for example, now they're not able to trace you, they're not able to trace an address, and you only have an IC address and they post it, then that will be known as the date of service. Okay, or if they actually personally hand it over to you through a registered POS and you receive it, then the date of service is when you are served with that notice. Okay, Ali? And it's also very important that you make sure that you update your addresses to avoid any issues. Okay. So now, yeah. So I want to spend some time here because I've got some information that I want to share for reinvestment allowance. So I don't want to actually tell you about. I don't want to give you a lecture on reinvestment allowances, but this is one of the few incentives in Malaysia where you don't need a prior approval. Okay, so it is actually subjected to a lot of gray area, right? Loopholes. Okay, like for example, the taxpayers are claiming this tax incentive even though they're not meeting the conditions. Okay, because I don't need a prior approval. Like for example, if I apply for investment tax allowances or pioneer status, I need to make a prior approval before the project is undertaken. Right, I got to apply to MIDA. Right, I have to get approval from them. Only then I can claim. Right, but reinvestment allowances, if I meet the conditions or what I think I should meet the conditions. Right, so this one, ladies and gents, now when I started working in my accounting firm and subsequently in the MNC, we were harassed, right? It was not easy at all for taxpayers, right? So if you notice, there's always this possibilities that the public ruling is amended quite frequently, right? So it is actually quite. So see, just give you an example, right? Let me give you an example. Okay, and I don't want to go too much into this. I just want to give you highlights on this, but nevertheless, I want to spend some time here. Okay, so if I go to this public ruling, if I go to public rulings, right? So if I go to 2020, right? So here, this is the one we are going to discuss. Right, so we go to 10/2020 is this RA for manufacturing, and 11 is 20 agriculture. Okay, but if I go to, say, for example, if I just take this year, right? If I go to, say, let's say I go to, right? if I go to see, look at this. See, as early, right? As you look at the dates, huh? So 2017 was amended in 2020, right? So there's this constant change, case laws, change, case law changed, right? Then public ruling changed, right? So it's a highly controversial area, right? I had a very good ex-colleague of mine, right? I had a very good colleague, ex-colleague of mine. He works in a paint manufacturing company, right? He told me he was a chief, he's a financial officer there. He told me that if a company claims RA, you will be subjected to an audit. Okay, and so that is quite normal. We expect that. But he actually told me that every year there's a tax audit for reinvestment. Every year. If you claim RA, you will be getting a tax audit every 1 year, every once in 2 years. Okay, so it's a highly controversial area, right? So if there is any company who's going to claim RA, you better get it right. You better get it right. Okay. Now, when I was working in my MNC, I remember this is in 2007, I think, or was it 2005, right? Many years ago, 2005. I actually claimed RA, and I also claimed export incentives. I claimed 2 incentives in one. Sorry, no. This is in which year was this? Was this in this before self-assessment? It's during the old era. So even if you make a mistake during the pre-self-assessment days, it doesn't matter. You just revise the tax computation, you pay the additional taxes, kind of thing, right? But under self-assessment system, you got to get it right, right? So that important. That's how self-assessment is important. Okay. Okay. So I don't want to actually bore you on this, but let me just go through some key points. Okay. I want to spend some time here, but I will go through some main important points because this is actually, we normally do this for a few number of hours, but I don't want to spend too much of your time. Okay. Okay. So now, let's say is given to us under Schedule 7A, right? So Schedule 7A is the one that governs, right, of Income Tax Act provides reinvestment allowances. Okay. So there are certain conditions that is stipulated, and one of them is you must be resident. Okay. So resident, and you must be incurring qualifying capex, capital expenditure, capex on QP, qualifying project. Okay. So the main forms of this qualifying project would be in the form of what we call an MADE, right? An expansion, modernization, or automation, or diversification. Okay. And in the guideline, they've actually come out with a list of documents you need to attach. Okay. They want to see who's the one who signed the document, right? They don't want any accountant or a finance manager involved. They want the technical, like the engineer to be involved, right? They want their inputs, right? That you have evaluated this properly, because if you get it wrong, ladies and gents, right, you're facing a very severe incorrect return penalty, right? That could be 45%, right, up to 100% of the additional taxes. So it's very, very serious issue we're referring to. Okay. But ladies and gents, how do we survive? Right. So if I'm a manufacturing company, if my business is expanding, right, my only survival is actually reducing my effective tax. My tax rate is actually going to be reduced, right? So I will do everything within the law to reduce my taxes. Okay. But what could be within the law for you may not be within the law, right? So that's a controversy, right? So you have to make sure that you do the proper due process, right? The due process, the due thing. Now, we don't want to tell you what it is. I leave that, you are the experts, right? But it is very important you emphasize on this, okay? So you need to be, now, unfortunately, you cannot claim reinvestment allowances when you start your manufacturing operations. Normally, you have to wait for 36 months. right? So it was previously 12 months many years ago, but they changed it to 36. So you need to wait. So this is what we call a second round incentive, right? So RA or RIA, like my company, my old firm calls it RIA, but most of the people call it RA, is what we call you need to be in operations for at least 36 months. So it's what we call a second round incentive, right? So I've actually had a case where, for example, I had a company that actually eligible to was approved for pioneer status. Right? This is before the 97 crash. The 1997 crash, the first crash, one of the major crashes, it was the 97 crash. So before 97 crash, we had applied for pioneer status, right? And we have furniture manufacturing, manufacturing furniture in Nilai, right? So our projections was over the roof, the best, right? Our profits are very high, right? Everything is right. But then the 97, right? And it brought us down to earth, right? And it was a bubble, and the bubble burst, right? So it brought Malaysia down to earth. We were on top, but now we brought it down. Okay, so we learned our lessons. That's why 2008 we were not badly affected as the others, right? So we learned our lesson. Okay, so now this company, what happened is we applied for pioneer status. They did not even generate 1 Malaysian ringgit over the 5 years. Okay, they should have been better off by claiming reinvestment allowances. Okay, so there are processes where if you claim for a tax incentive, you can surrender the tax incentive, right, and then claim any other tax incentives such as reinvestment allowances. Okay, so there's a possibility that you may not get your act correct, right? So you can withdraw or surrender. Okay. Now, one of the requirements for, or one of the conditions for RA is if you're making a claim and if it is actually disposed of, right, under the definition of disposal of, like, for example, if you transfer it off or you sell it off within 5 years from the date of acquisition, then the RA is withdrawn in the year of disposal. Okay, so it is actually a very, very good tax incentive, right? Why? Because you have actually claimed 100% for the capital allowance. So let's say you're actually buying a machine for 1 million, you can claim capital allowances, right? Over the years, you can claim say 20% and 14%. You can claim 100% eventually, but on top of that, you can get a very special rate of an additional 60%. So you're going to claim effectively 160% on one asset if you qualify and meet the conditions for reinvestment allowances, right? So because you're claiming extra, the IRB is going to ensure that you're going to reduce your taxes, right? And if you're going to reduce your taxes, you better make sure you're meeting all the criteria. Okay, so one of the issues that they've actually mentioned, which is, in my opinion, very unfair. My opinion doesn't matter. Nobody cares about my opinion. Sorry, right? So Ravi, nobody's bothered about your opinion, but anyway, this is my opinion. Okay, so this definition of manufacturing, right? They've actually excluded simple manufacturing. Like, for example, let's say you're manufacturing ice, right? Ice is a massive, a mega business in Malaysia, right? Because of our weather. But let's say you actually buy a machine that is going to, say, modernize my facility, right? Manufacturing. So let's say I spend 100,000 in the machine and I enter into what we call this, sort of a automation or a modernization or an expansion program. Okay, so let's say my demand is at the moment increased, let's say 50%, and I'm not able to meet the demand, so I'm actually incurring capex. Okay, so therefore, in this case, let's assume I'm resident, I'm operating for more than 36 months, right? At least 36 months, right? And I can claim RA, right? Because I'm incurring expenditure for a qualifying project, right? But now, then they tell me, oh, sorry, it must be very heavy, right? It must not be too simple. It must be very, very heavy. It's a different, that means your manufacturing we're referring to excludes simple. Right. So if you look at this gazette order, there's a list. It includes ice manufacturing is excluded. the thing is, we make, ice manufacturers, yeah, we agree that they make money, okay? But it is actually not very fair to say, oh, you are too simple, right? Why is it that manufacturing gloves, right, or tiles is more important than manufacturing ice? Yes. So what they're saying is, the input, right, and the output is almost the same. There's no difference, right? But you see, we are looking at, for me to manufacture ice, for example, right, I need a manufacturing license, right? So let's assuming that I need a manufacturing license means I'm a manufacturer, right? And I had to, you think what ice is coming from the air, I had to spend money law, huh? The easier, right? So therefore, if I'm expanding, right, if I'm meeting the qualifying project, right, but unfortunately, they have been excluded under this Gazette order, this 2012 Gazette order, okay? Now, as far as your factory and plant and machinery, they've actually mentioned that it must be directly used, right? Directly. So the word, whatever is directly used, right? And in carrying out your business, okay? Now, forklifts that is not used in the factory, for example, but if it's used within factory manufacturing processing claim, but if it is not, then you can't, right? So forklifts, for example, used for the factory for the conveyance of materials products can be eligible for RA, right? Now, computers for your office cannot. So whatever that is, used for your administrative office, clerical, right? That is excluded. But if it is used in the production, in the process or linked to the production equipment, then you can claim, right? So they've actually been a little bit flexible, right? So the guideline actually helps us. Okay, the guideline helps us. Okay. So, for example, if you're actually now incurring expenditure for replacing a machinery, right? So pure replacement, right, is not eligible for reinvestment allowances, right? It must meet this qualifying project. Okay, so pure replacement is not eligible for RA. Another important change that took place and was incorporated in the public ruling subsequently was if there's a related company that has claimed RA, then the subsequent transfer, even though it may be a qualifying project, the transferee company or the acquirer company cannot claim RA, right? So because otherwise the government becomes Pokai, right? That means, let's say, for example, if my Penang subsidiary claims RA, they bought a machine for 1 million, they claim 60%, 600,000 RA, right? And then they transfer it to their sister company in Johor, right? And the sister company claims RA on that machine, and then the sister company sells it to another brother company. Then the government become bankrupt, right? So that also they've actually made the public ruling actually makes some provisions for if the transferor company who is disposing it off is not claimed, then you can actually consider claiming if you meet the requirements, right? But it depends on the circumstances. Okay, so now there's this controversial area whereby there was this. Let me just show you that. Right, let me just show it to you. Let me get access to this. Sorry, it's not working. Let me just access this again. Okay, so let's say, for example, I'm incurring expenditure. Say I'm actually incurring on a expansion project, right? So I'm having a factory, and I'm actually spending it for, say, 1 million, And here, let's say the manufacturing process, right, has, let's say it is, say, let's say 80%. Okay, but then the storage area, right, to store your raw materials, right? So the process was 80% and the storage area was 20%. Okay, so this taxpayer said that he incurred, right? He incurred on a qualifying project, which is my expansion. I'm meeting the criteria. But they actually said that. So for the taxpayer, they claimed their qualifying capex for RA purposes as 1 million. So they went and claimed 1 million. Okay, they claimed 1 million. Okay, so they claimed 60%. Okay, and so therefore, if I actually do a very simple calculation here, it tells me that I am eligible for 600,000, right? And let's say my statutory income was say let's say 100,000. I can actually claim, right, up to the amount of RA available, but it is restricted to 70% MSI. Right? There was a restriction, so therefore I couldn't claim 100%. So I can only claim 70,000 out of the 700,000 out of the 600,000. Okay, so therefore I have reduced my taxes legally because I've entered into a claim, right? So if I've actually now incurred, say, for example, if my statutory income is very high, let's say, for example, if it is say 10 million, then in the full amount, because it is the 70%, right, is lower. Again, it's 7 million is higher than my RA available is only 600,000. So I can claim 600,000. Okay. Okay. So this is basically effectively reducing my taxes. Okay. But during a tax audit, the IRB actually came and said, you cannot claim your QC is not qualifying capex is not 1 million. Right. So the IRB actually does then says that since you're only doing the processing using 80%, then you can only claim 80% of. So therefore you have, right? So that means if I take 60% of this amount, the amount that you're going to claim is 480,000. And you have claimed 600,000. What we're going to do is we're going to, right? Don't worry, we will amend for you, right? So I'm going to claim this amount, right? So you have overclaimed. Your statutory income is now, statutory income is higher. Okay, so there'll be penalties under additional taxes to pay and a penalty, right? So a rising dispute, when they landed up in the courts, the taxpayer successfully argued that if I'm going to carry out an expansion, this storage area is very important for me. I cannot carry out the storage, cannot be actually carrying out this activity of expansion without the storage area, right? So and the law was actually not clear, but now arising from the change in the law, right? Now, if there is a factory, let me just get this. Okay, so if there is a factory, right, it's used to store raw materials and finished goods, and as long as it does not exceed 10%, then you can claim. Okay, so coming back to our example here, right? So as tax advisors, right, before you embark on your project, why don't you consult? Right? So before you consult, before you can undertake, right? You say, look, I'm going to. So during a management meeting, they're inviting you, and you say, okay, we want to carry out an expansion program. Okay, we expected to spend about 1 million plus, right? So Ravi, can you give us some advice, right? So then I asked them, okay, look, you have your what is the information that you have relating to the processing and say the storage area, right? And then they say, oh, at the moment we are actually now planning to have a storage area. So what we can tell you is, right? Your storage area, you don't do it as 20%, right? So you make sure that it's not exceeding 10%, right? So you make sure it's say 8%, and then automatically this will be 92%. Okay, now if this storage area is not exceeding 8%, right? Not exceeding 8%, you are eligible to claim based on 1 million. So the IRB, based on the law, will accept this 1 million. Okay, so they will not insist on this. Okay, but if it is 20%, then sorry, you can only claim 800,000. Okay, so now the point is, because you see, asking, right, asking the right people, the right questions at the right time, right? Asking the right people, the right questions at the right time, right? Now, after, let's say, for example, now you did this transaction in 2021, and in 2022, I'm writing to the tax client, my client, and saying, excuse me, sir, give me information on this, your storage area, how much, huh? And they say, oh yeah, Ravi, this one is, it is 80% here and 20% storage area. Then I say, oh, sorry, Minta Maaf, you cannot claim based on 1 million. You only can claim on 800,000. So then the taxpayer is going to ask me, sorry, Ravi, can you just repeat what you're saying? No, actually, there's this law saying that, if you're actually having a storage area more than exceeding 10%, you cannot claim the excess. All right, so that means if 20% means you cannot claim on the 20%, but the balance no problem, 80% you can claim, right? Then he turns around and says, so that means, are you saying that I cannot claim 600,000? I can only claim 480,000? Yeah, check, yeah. Now, Ravi, you think this money is actually coming from the air? Huh? You think this money is actually what you think is given to me as a gift, right? Now my boss is going to ask me, how come you're not actually claimed based on 1 million? Why was this not based on 1 million? Why is it based on 800,000? Oh, no, a tax agent just said, who is that tax agent? Call him. I want to see him now. We also can play our part, right? So we also need to be proactive, right? You cannot be reactive, right? So if I had actually asked my question, hey, Brian, hey, you guys, this 2021, what's your plan, huh? Right? So in 2020, you ask the client, right? Hey, what are your plans in 2021? Then Brian will actually, the client will actually tell you, oh yeah, we are planning 2021, we are planning to incur this capital expenditure, right, on this expansion program, right? And then you say, look, okay, maybe when you're doing that, why don't you call us in, right? We'll charge you a small fee, right? I'll ask my boss, but is it okay? And your client is actually ever happy to actually pay if there's value, right? Now, you see, we don't want a situation whereby, because we do not have a relationship with the client, right? And the client ends up paying more taxes. You see now, if he did not ask me the question, now he's going to pay more taxes. His income is higher. Right? Because I'm only getting a distribution 480. Right? So another thing that we also can play our role, whatever role it is, right? Whatever role, your own company or your client company or whatever, you're teaching something or whatever it is, right? The idea is to make sure that you are paying less taxes as prescribed within the law. Okay, so the reason why I'm telling you this is because I got tarot. I got tarot from my client. Sorry, my boss, not client. I was working at the same MNC, so it is my boss, right? But of course, it's not relating to RA. It is considered, it is something relating to something else, right? But that is something that is going to be useful to your, let's say, for example, your teaching, right? So if they realize the gravity of the situation, right, they will benefit. You see, I don't get a benefit by teaching. I get paid, right? But if I can actually just instill in them, hey, look, why don't you relook into this? You can do things earlier than later. Okay, that's all we can advise, right? Okay, that's all we can advise. And I'll give you another case study, right, later. Right, I'll give you another case study later. Now, another controversial area was this. There's this notice, you see this 1998 onwards. See, in 1998, right, they actually said the maximum RA you claim, if your claim prior, let's say, for example, you're a 1990 incorporated company, 1990, and let's say in 1995, you claim RA, right? Now for you, right, from 1998, they already said you can claim 5 years, 5 consecutive years. Right, so all the professional bodies, the industries, right, all the associations, actually, FMM and all that, they said no, cannot. So they increased it, and the law now is 15 consecutive YAs. So one company who's meeting all the criteria, once you claim in 2022, for example, let's say you establish your company in 2015, and your first year of claim is 2022, you got 15 years from 2022, but it's consecutive. Whether you claim or not, the 15 years will keep it on running. Okay. And then I said, you have met the conditions. Okay. Now, let's say, for example, I incorporated my company. I claimed in 1998. I got 12 years. I said 15 years until, say, Y2012. And for those companies who have already utilized the 15 years, the government actually keeps on coming and extending it. Right? They say, okay, okay, for the you already claimed 15 years, right? Right? Okay, we'll give you certain additional years, and each budget. Right, if you look at the updates later, each budget will say, okay, we're giving you up till 2024, 24, for example, right? So they give you some concessions. Okay, so there's this third extension now for companies from 2023 to 2024, right? So there are certain conditions, right? But all I can say is I'm very happy to inform that the government realized, right? Taxpayers need help, right? So the government's principle is very easy. The taxpayer help yourself by reducing taxes. Right? That's exactly what I want. Right? Exactly what I want. Okay. What the government's aspirations are met and the taxpayers met. Okay. Now the rate is actually fixed at 60%. Okay. So if I'm actually now incurring some, say, for land, for example, for my factory and plant and machinery and office equipment, I won't be able to claim. I won't be able to claim for the non-qualifying such as land, but I can claim for the factory and claim and all this office equipment with the director's car and all that, you get nothing, right? You can claim capital allowances, but you cannot claim RE. Okay, so the qualifying capital expenditure for year 1 is 500,000, and you are entitled to a reinvestment allowances of 60%. Okay, so this 300,000, you can claim it against your statutory income for that particular project. Like you would say, for example, energy saving lights, right? You were given pioneer status, and now you are going to claim under second-hand incentives, right? And let's say in 2022, you're including, this 500,000. Then you can claim, right? But you got to compare the RA available, right? So the RA available is how much? Is 300,000, but you got to compare it to 70% of statutory income. So the amount you can claim, whichever is the lower you can claim. So you can claim only 70,000. Okay, but don't worry about the balance. Okay, the balance you can carry forward. So this 300,000 minus 70,000, the 230,000 you can carry forward. Okay, carry forward, right? And for RA, there's a 7-year restriction, right? Which is proposed just like unabsorbed losses. There were 7 years, but under the last budget, the previous budget, they went in. Only the losses they actually went and extended 10 years. But generally speaking, for RA, is just like the losses, but not CA. CA there's no restriction. No, any number of years is okay, but not RA. Okay. So now another incentive that is given to us, or concession rather, sorry, not incentive, concession is in 1 year, you may be able to claim 2 incentives if you have a brought forward. Okay, like for example, in this case, let me give you this is example 45 of the public ruling, right? The 2020 public ruling. So let's say this company K is manufacturing frozen food and they claimed an amount of 70,000 as part of their export incentives. Okay, so they got export incentives. So this main incentive you can claim up to 70% of your statutory income, right? So if I take 70% of SI is 210,000, right? 7 times 3 is 210,000. So in this case, I've already utilized 70,000. So I've got a balance, right? Since I have a brought forward incentive in the form of, say, let's say RA, I can claim 140,000. Okay, so but you're not claiming 2 incentives in 1 year. You're not claiming RA main incentive and export incentive is main. You're only claiming 1 main incentive, but the second incentive was a brought forward incentive. Okay, but that you can only claim if you have a balance of unutilized amount of the 70%. Okay, so basically the message for you is, I don't want to go into the rules, but there's a possibility that you may be able to utilize an unabsorbed brought forward balance, right? And claim an additional incentive, all right? But that should be your main incentive, okay? And the government has actually made a concession, right? Which is again, very, very good for a taxpayer who is struggling, right? Taxpayers are struggling, ladies and gents. I don't have to emphasize, you are the experts, you know better than me, right? Okay. For under the reinvestment allowances for agriculture, there's this allowances established, right? But it's very unique. So agriculture allowances are slightly different from normal allowance, cap allowances on IBAs. Here you have a one-off flat 10% on, say, any building that is used for office, for example, right? Or if it's a construction of living accommodation, then it is 20% flat, right? And then expenditure on clearing and preparing a land or construction of roads, which is you can claim 50%. Okay, there's no initial allowance, there's only one allowance. And when you, for an approved agriculture project, you got capex incurred for buying the land, you cannot claim. But for clearing and preparing the land, you can claim. It's a qualifying agriculture expenditure. And irrigation of drain pipes and any plant and machineries, you can claim, right? Depending on the plant and machinery, of course, you can claim cap allowances on that. Okay, but for agriculture allowances, right? And the list given for agriculture projects is cultivation of rice and maize, vegetables, tubers and roots, fruits, right? Fruits. So fruits is actually connotating fruits is that's something that you can eat, right? Although we have a famous case for oil palm fruit, but the one we're referring to is edible foods. So livestock excludes chicken and ducks, right? But it includes say cattle, deer, goats, right? Buffaloes is big in Malaysia, and the like. Okay, and aquatic like sotongs, right? Prawns. Rearing a chicken and ducks, ladies and gents, that was excluded. That is excluded. We cannot get this anymore. So now, let me just check. Okay, now let me just review the question. We'll just say, right? We'll just have a look at the questions. Yes, for the RA, there's a maximum 7 years, but not for the ITA. Tanchin? No, not for ITA, only for RA. Okay, so losses, IT, RA, right? And then we have a few others also, okay? But excludes ITA, right? And CA also is excluded. Remember the original budget had? Yeah. Yeah, there's some questions here. Let me just quickly go through it. Huh? Okay, so we had market value. Can I just check the? Yes. Yeah, I mean, outstanding taxes was basically he's actually had an appeal. He actually successfully made appeal for a standover of the taxes, right? But there was an amendment in the act, right, which says that regardless of whatever courts or whatever circumstances, so that was actually under, right? So let me just go to that. Just give me a minute. We clear that, then we can move on. Okay, so here, let me see whether I can get it here. So let me go here. So 1, 0, 3, 1 second, please. Please hold on. Okay, so this is called collection of taxes, right? So collection, right? So collection and recovery. Collection, okay. So this is 103, right? So this is called payment of tax, right? So here, this, right? So this 103B, right? So it states that it's tax payable regardless, right? Notwithstanding means I don't care. Notwithstanding means regardless, right? Regardless, the institution of proceedings under any written law, right? So in this provision of 103B, right? So the institution of any proceedings or any other written law against the government shall not relieve any person from any liabilities of the payment, debt, or any of the sums which he is or may be liable to pay under its part. Right. So this is introduced and effective from 1st of January 2021. So regardless of whatever you do. So one of the reasons why we used to go to apply for a judicial review to go to the High Court was there was a small loophole where you can actually pay the additional taxes or the tax due on the assessment only upon this finalizing of the appeal. Right. But because of this provision 103B, that loophole has. So now if you go to JR, you go to High Court also straight. You go to High Court straight, you still have to pay. Okay. Now, as far as the former PM, because he actually had recourses because the amount involved was considered to be quite high. So he had actually made applications to make an appeal on those grounds. So he had actually made to the courts for a special application so that he doesn't have to pay tax, and he was successful in doing that. Okay. Okay, so now the application. Yes, yeah, the application for extension of time is when you fail to meet the guideline, deadline, right? So once they issue the assessment, right, and if you don't meet the 30 days from the date of service notice, then you can apply for Form N. And normally Form N, they are quite concessionary and they give it to you based on good grounds, right? Normally they're okay. Yeah, so whether she has to pay, the answer is she has to pay, right? She has to pay regardless of the appeal, right? So regardless of the appeal, right, Brian, whether Sarah whether Sarah likes to appeal or don't appeal, you pay your pasal, you pay your tax first. So pay first. What's the motto, Brian? Pay first, talk later. So that's a good, right? That's the one your boss always tells you, right? Yeah, you don't talk like, pay first, right? Do your job first and then you talk later, right? So that's what the IRB is telling us. But the IRB is telling us slightly different. They say you pay first, then you talk later, right? Okay, so yeah, so we discussed that. What else? Okay. Yeah, so there are some incentives, automation. Yeah, there are various exemption orders, right? And incentives given to you, right? Yes, there are incentives. Okay. So now let us continue, right? Okay. Now may I ask you, do you think it is something yeah, the penalty will actually apply, right? So if you have, so if you you see the pen, you see the is like this, Tanchin, right? You have no choice to pay the taxes. Okay, so you will have to pay, and normally there will be already a penalty imposed. Normally, if there's a penalty imposed, but there's no further penalties on penalties. Okay, there's no further penalties for penalties. So therefore, the amount of tax due and the penalty due is due whether you make the appeal or you don't make the appeal. Okay, so whether you make the appeal or you don't make the appeal, you still have to, right? Whether you want to appeal or you don't want to appeal, the tax due and the penalty amount is due and payable. Okay. Okay. So now, before I proceed to the few points before lunch, is it too fast? Is it too slow? Is there any comments? Or is this the right space? I would like to, actually, I'm very happy for you to spend your time here. So I'm very, I would like to, is there any comments? Nice space. Okay, thank you. Right. So like I said, Tanchin, right, Kanyadri, Karen, yeah, like I said earlier, the only thing we are missing is, right, is that voucher, right? If that pizza voucher is given to us, we can actually order the pizza. We can discuss during lunch, but that's a bad idea, right? So during lunch, no talking, enjoy our lunch. Okay. Okay. Okay, so let's proceed. Okay, let's proceed. Okay, thank you very much. Thank you very much. Right. The information, yeah, maybe, yes, true. But actually, we don't want to go into too technical issues here. We don't want. I just want to go into a broad overview. All right, certain micro issues, certain macro issues. But you notice that the importance of taxation, right? So you notice the IRB wants us to treat tax is very important, and that's what we are doing. Okay, we're trying our best to help. Okay. Now, another controversial area, which is something that we briefly discussed earlier, arising from this very famous case called the Clearwater case. It's a Malaysian case where there was this the Clearwater Golf Sanctuary case, where when they received the amount of income for services, right? For services rendered and to be rendered. So if you look at this, for services rendered and to be rendered, right? For services rendered and to be rendered, after this amendment. So this any use or enjoyment. So any income that you receive in advance, let's say, for example, your for rental income, right? This would be actually subject to tax, right? And this has actually got a serious impact, right? And a typical example would be, let's say, for example, now you're entering into a golf club, right? So you have to pay 1,000 ringgit for each year. So you become a member for 10 years. So you pay 10,000 upfront, right? So that 1,000 for, let's say in 2022, you paid 10,000 for 10 years, okay? And in 2022, for accounting purposes, we already recognize 1,000 because it's for services rendered for 1,000. So every year I will recognize the balance of the 9,000, right? So every year for the next 9 years, I will recognize. But for accounting purposes, I only recognize 1,000, right? So the balance of 9,000 is sitting as my advance income received, right? And I will actually debit it and bring it back into tax every year, right? So, but for tax purposes, the IRB actually insisted that since you receive the money, what is the problem for you? Why can't you pay taxes when you receive the money? So then they actually argued successfully that it is for services going to be rendered, and only for services rendered is for 1 year. For services going to be rendered, since the act at that time, before this amendment in 2016, already stated that for services rendered, for services going to be rendered was not subject to tax, right? So the courts actually agreed that it is not taxable. So again, there's a very important SOP that the IRB follows, right? If we lose case, change the law ASAP. Right, so the IRB from the IRB's SOP is quite simple. It's quite a small paragraph, 2-liner. If we lose case, change the law ASAP. So they changed the law, right? So after these amendments, so any advance income in respect of services or any say rental, for example, or use of enjoyment or any properties, that advance income is taxed in the year when you receive. Okay, but let's say, for example, subsequently our member, let's say after 8 years, he decides that he doesn't want to be a member for the 9th and 10th year. Then when we make the payment back, right, when we make a refund back to them, right, when the income is received in advance but refunded, that you can actually claim a deduction for it. Okay, and for tax purposes, when you're actually not charging each year, if you already paid tax in it, you got to make sure you monitor so that you don't have to pay tax since you already paid taxes for 10,000 in year 2022. So in 2023, when they charge the 1,000, you got to make sure you don't pay tax and then you must less it out, right? And to show clearly that you've already paid taxes, right? And also under 34(7)(a), you can claim a deduction for the refund paid for the services that is no longer going to be rendered. Okay. So that is arising from this famous case all Walam Rosa Clearwater case. Okay. Now this one, ladies and gents, is a very, very sad case, right? Very, very sad case. We were actually under a lot of pressure. So Malaysia was under a lot of pressure, just like Hong Kong, right? So there were some pressures from some corners from Europe and OECDs and all that. So they were actually saying that you must have a fair treatment, right? So arising from this, they actually went and in the budget, they actually announced that they were going to amend the provisions of Para 28 Schedule 6. So this Para 28 was actually quite a useful exemption because it's exempting every person except for a bank, insurance, and sea undertakings. Now here the RB's, the government is actually working on guidelines. They've actually mentioned that they've issued this exemption, income tax exemption order 2022, right? Or what we call this PO 96 2022. And here they've actually given us exemptions from income tax to be given for 5 years from 2022 to 31st December 2026 on certain types of categories of foreign source income. Right, so for individuals, foreign source income is exempted, and companies' foreign source dividend income is actually exempted. but we're waiting for further information on this. We're waiting for further clarification on this. So we hope, right? Now, during the last budget, the 7 years was applicable for unabsorbed brought forward losses, but now it is 10 years, but nothing else has been exempted, okay? So RA has got a maximum 7 years, no change. Unabsorbed pioneer losses, 7 years, and investment allowance, not investment tax allowances. Okay, now this one investment allowances for approved services project, like for example, transportation, right? Like Malaysian Airlines incentive under 127, but this is under Schedule 7B. So this investment allowance under Schedule 7B has a maximum 7 years, and also the three subsectors. One is transportation, like Malaysian Airlines, telecommunications, like our good friend DG and Celcom, and the utilities like Tenaga, right? So they are eligible to claim what we call investment allowances. And there is a 7-year restriction, which we understand there's no change, okay? But these are the only ones that are affected. And the last budget, they actually announced for the losses because of the current economic situation, they've actually decided to extend it.